all in all, earnings were pretty good across the board.
The beats are being rewarded.
The equity market overall is doing fine.
There's still lots of demand for equities.
The right trade is not to trade. Hold your core positions.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday with some extra intervention. The US and Japan teaming up to support the Japanese currency. As the president is scrapping planned attacks on Iran to focus on talks, it's combining to send crude down, equities higher, and helping the yen hold on to big gains.
This is a huge deal. This is the first bilateral coordinated currency intervention with the U.S. and another country going back to 2011, when a group of nations helped Japan depreciate their yen in response to the earthquake and the tsunami. So here is the question, and you were alluding to it last week. Why? Why is the U.S. doing this, and why now? Is it because of some sort of financial benefit that, as President Trump was alluding to? Was it because we help our friends, as he was talking about and Scott Bessent was talking about? Or is this also a yield story that potentially could come to fruition?
I would argue there is a policy response that the U.S. is hoping to avoid, and there are two of them. One is Japan actively selling lots of treasuries to support their currency. And two, Japan actively encouraging Japanese investors to repatriate capital, again, which would weigh on the treasury market. This is not a great backdrop right now for treasuries already to begin with. The latest developments in Japan leading up to this don't help.
And some people are debating, speculating that the shift higher in long-end yields, with 30-year yields rising to the highest levels going back to 2007, did help motivate some of this activity. Nonetheless, it highlights what the motivation would be for the United States, aside from just helping our friends.
The Treasury Secretary is in a tough spot right now. Put it all together. You've got the international developments, Japan, the hit to Fed credibility just last week, plus, and Lisa, you've talked about this endlessly all year because it's so important, the additional supply coming from everywhere else in this competition for capital.
So it goes down to what can they do? At this point, is it just issue on the front end, have the front end pegged by the Federal Reserve, and at some level just allow the long end to float and hope for the best? Or is this going to be some sort of coordinated action to bring down long-term yields? There's only so much he can do. And that ultimately is the crux here. Going forward, this to me is going to ultimately rely on what the Takeishi government does and what other governments do, because at the end of the day, intervention can only do so much. At a certain point, there has to be a policy response of either hiking rates or potentially curtailing fiscal spend. And without that, this can only go so far.
I think Mohammed Al-Erin put it nicely over the weekend. You're fighting gravity. And at the moment, it feels like you're fighting gravity. Let's talk about the US bond market. 2s, 10s and 30s. Yields declining throughout this morning. We're down 4 on 2s. On 10, we're down 5. Your 10-year this morning trading around 470 still. On 2s, around 425. This move in crude is helping WTI and Brent. Unfortunately, we have to talk about the same old story. 84 on Brent, 80 on WTI. And I'm sitting here and I'm going to say the same thing again. The story hasn't changed. It's the uncomfortable new normal where we just toggle between strikes and talks, strikes and talks. This morning, it's talks.
And the problem for market participants is that the stakes are getting higher and higher as it brings in more parts of the world. You have now the Saudis and the Houthis actively fighting one another. You have this question of proliferation in Iraq, Oman, etc. You start to look at all of the potential for escalation and widening out in the conflict. And it's keeping people very nervous. At the same time, oil potentially can keep flowing. And I was looking, actually, this is an interesting statistic, that the stockpiles of oil in the U.S. have declined 19% since April. That's a lot, but not nearly as much as some people would expect.
The U.S. once again talking about talks and Iran denying they're happening. We're doing that again on a Monday morning. Shock. The week ahead looks like this. Into Friday, we're all building up to one thing. We're looking ahead to payrolls Friday. Lots of labour market data in between. A sneak peek of the estimate here at Bloomberg in our survey, 80K is the median. You'd have to think that an 80K this Friday would keep the rate hike bets alive and well into September.
Especially because the unemployment rate is expected to stay at 4.2%. Watch the JOLTS data, the ADP data, to give some indication of what wage growth could look like. This goes to what we heard from Beth Hammack and others, where they're worried about it spiraling out of control in terms of inflationary inputs that take on a life of their own. To me, this highlights how much more volatile the market is going to be to every data point, because we aren't getting a clear guide, although we are getting a lot of Fed speak this week.
Welcome to August, everybody. July was exhausting and the S&P 500 was basically flat. unchanged. Beneath the surface, pretty violent. We'll talk about that throughout this morning. Coming up this hour, we'll catch up with Stephen Cook of the Council on Foreign Relations as President Trump claims an Iran deal is imminent. Jeremy Stretch of CIBC as the US and Japan combine forces to support the Japanese yen. And Mark Cabana of Bank of America as Fed Chair Kevin Warsh considers cutting back on meetings. We begin this hour with equity futures pushing higher, crude lower and bonds rallying as the US and Japan are teaming up to support the Japanese yen. Joining us now to discuss is Phil Orlando of Federated. Phil, welcome to the programme, sir. We talked about it briefly at the top there. I'm sure you were tuned in. What is it about this right now and this backdrop that has prompted the US to get involved to help the Japanese?
Well, the relationship between the dollar and the yen was at roughly a 40-year high for the dollar, low for the yen. And I think the Japanese government simply reached out to the U.S., indicated that they were going to try to reverse the weakness in the yen. And the two countries are excellent allies. The United States needs more friends rather than less friends, given the very strange and strained period of geopolitics that are going on right now. And I think the United States agreed to support the efforts that the Japanese were going to institute.
Do you believe, Phil, that US participation goes above and beyond that? That their interests are beyond just helping out an ally, a friend? There are some concerns building about the backdrop for the Treasury market.
Well, it's a perfectly valid thesis. You and Lisa were talking about it. Perhaps there is concern that there would be a disintermediation of Japanese money out of U.S. Treasuries, and that would have a deleterious impact on U.S. interest rates, while rates have already gone higher. You talked about, benchmark 10s are already up to 470 or approaching that. Our view is that we could see yields continue to drift up to 5%. U.S. probably doesn't want to see that happen. And if a significant ally, one of the most important economies of the world, is looking for some help, and we can forestall our Treasury yields moving materially higher, then perhaps we would try to participate in helping that become achievable.
Phil, you don't think that the Fed should hike rates or will hike rates throughout the duration of 2026. With your vantage point that maybe what the Fed did this week was the right thing, why do you think long-end yields moved up so much?
Because I think investors are concerned about two things. The fact of the matter is that U.S. economic growth is very strong, and there are inflation concerns. And so as a result, absent the sort of forward guidance that the Federal Reserve might ordinarily provide to investors, perhaps under the Powell regime, bond investors are going to do what feels more comfortable to them, which is to push yields higher. So as we're looking at the situation, though, economic growth is pretty good. We think the core private domestic final sales number that we saw last week, 3.9%. GDP growth is solid. And inflation, which spiked during March, April, and May as a result of the conflict in Iran, came down substantially in June as we got some reprieve from the fighting. So as we look out over the course of the next couple of months, we'd love to see the Iranian situation stabilized and have energy prices come back to more normal levels. So from our perspective, the Federal Reserve were to be hiking interest rates here, given a normal policy lag, as those higher interest rates would begin to take effect, energy prices might be back at, let's say $70 a barrel. That would create potentially a deleterious impact on labor market strength and economic strength. So the right course of action for us would be the Federal Reserve to sort of look through this energy supply shock and be patient and right now do nothing until we've got some better information.
Based on that, Phil, are you buying duration? I mean, just to take a step back, regardless of what they should or shouldn't do, right now, the market's not getting a lot of guidance, and it's unclear exactly how they're going to operate. Long-end yields are going up. Do you think it's a buying opportunity for both long-term bonds and high-duration stocks that have sold off and been punished in the wake of this?
Our duration committee at Federated Hermes, which is chaired by R.J. Gallo, put out a note last week based upon their latest duration committee meeting, and they've decided to stay at neutral. So I guess there's the potential. They believe that rates could continue to drift higher. And if we were to get something in that 480, 495% neighborhood, you might see them lengthen duration at that point. But given where we are right now, just under 470, and the uncertainty of the situation, I think they're suggesting the best course of action right now is, again, to be patient, be neutral, and wait for some additional guidance.
Do you think it's becoming increasingly problematic for the outlook for equities?
Well, certainly. If we're right that yields continue to drift higher up to 5%, that could potentially continue to result in contraction of price earnings multiples. Now, you look at from where the S&P 500 was, or the NASDAQ for that matter, where they hit record highs at the beginning of June, the S&P is down, 4 or 5% over that period of time. We could see a like move down over the next couple of months. So let's say a total move down to the 200-day moving average, down around the 7,000 neighborhood, give or take. So if we were to see continued problems in Iran, continued concerns about inflation, continued drifting higher in Treasury yields, that could absolutely facilitate, another little bit of an air pocket here. Let's call it another 4 to 5% on top of what we've already seen over the course of the next couple of months.
Phil, it's good to see you. Appreciate the input. Phil Orlando there,
thank you, John.
Federated. Phil, thank you. Even them, they don't expect hikes from the Federal Reserve anytime soon. There's concern still about a drift at the longer end of the curve, and we've seen the long end of the curve become somewhat untethered repeatedly over the last several years. And the reasons for it, Bramo, the list is getting longer, not shorter. And that's a problem for anyone issuing debt right now.
It has to do with just the fundamentals of debt growing dramatically around the world. It has to do with who's going to buy when people are selling in order to support their currencies and their economies. Torsten Slok actually came out and he had a great note over the weekend where he said, why did long rates go up during the press conference? And he focused on not what happened during the press conference. There was some oscillation, but it was really after the press conference. And ultimately, he said, yes, he reconfirmed the idea of getting to 2% inflation. He didn't explain how. And he likened this to saying, I'm going to take you on a trip to Los Angeles, but I'm not going to tell you how, and I'm not going to tell you how long it's going to take.
We might walk.
You might walk, or you might say, we're not going to Los Angeles, which is essentially what this market is saying.
The preferred tool. He gave a nod to the interest rate tool, but only a nod. Could, maybe, might. And left open a possibility of using balance sheet, which again would contribute to a drift higher in yields as well. That uncertainty and lack of clarity is contributing to the move we're seeing.
So the Wall Street Journal came out with an op-ed that was scathing to everyone who was whining, and I read it. I said thank you for releasing
personal?
To me. It felt very personal, and it was talking about, not that I'm whining, and truthfully it was saying Wall Street's whining, stop your whining. You're used to a Fed that holds your hand, and now it's not going to hold your hand. And Kevin Warsh is doing exactly what should have been done 10, 15 years ago. And I was reading it, and they kept saying people are looking for forward guidance. And I said this all comes down to, once again, people conflating the idea of forward guidance with reaction function. They are two different things. They have distinct purposes, and they are not the same in terms of giving a market some sort of framework to have a sense of exactly how to respond to economic
Was
data.
this a note on being the Lionel Messi of central banking? Was that the note from Citi?
It was that they were talking about?
Yeah.
It was different. They were talking about something else.
Okay, all right.
It was just scathing, and it was saying, the journalists are responsible and Wall Street's are responsible.
No, you've got to park that. This is not about hand-holding. We're all very, very open to moving to a world where the hand-holding of the post-GFC architecture is completely destroyed. Totally open to that world. It wasn't even just about that. I don't want to go over it too much because I'm bored of it too.
Yeah.
But last week was way more than just about the end of forward guidance. It was about a lack of clarity on the preferred tools. When it comes to the inflation target, is it still going to be the inflation target? How does that change in the next 12 months? There were open questions left unanswered about that as well. Then it was just the tone, as if the Federal Reserve was only just thinking about these massive debates, these massive issues that have dominated discourse now for the last half a decade.
Going into this, I was going to say more transparency, the better. And then I read the article about how Kevin Warsh is thinking about moving it to only 6 Fed rate decisions a year and have 2 meetings where they just talk about big issues. And I was thinking maybe that would be better because ultimately I don't think that we gleaned much information from that press conference.
I would agree with you. This came from Bank of America again this morning, called it a credibility shock over at the Federal Reserve, and said the Fed is facing a credibility problem, that hiking in September could become imperative to regain the narrative. The latest from BofA a little bit earlier this morning. Let's give you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The yen rallying on speculation the US and Japan may have intervened for a second time after a coordinated effort last Thursday. It was the two countries' first joint action in 15 years. Japan is estimated to have spent $53 billion last week. It's unclear how much Washington spent. Federal Reserve Chair Kevin Warsh is considering changing the Fed's meeting schedule, as you've been discussing. Sources telling us here at Bloomberg, Warsh is thinking about cutting annual policy decisions to 6 from 8, while reserving 2 gatherings for in-depth discussions of economic issues. And it is a merger Monday. Potentially, AstraZeneca exploring an acquisition of Bristol Myers Squibb. Sources telling us here at Bloomberg the discussions are at an early stage. The 2 cancer powerhouses would form the world's biggest drug maker with about $107 billion in annual revenue. And that is your Bloomberg Brief. John.
Hey, Bonnie, thank you. Thank you for the update. Up next on the programme, renewing hope for a deal.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal.
It wouldn't be a Monday morning ahead of the Open without more talk. Stephen Cook of the Council on Foreign Relations joins us next, live from New York City this morning. Good morning. I'm not sure I missed this over the weekend, this piece from the Wall Street Journal.
It's amazing.
I'm reading it in the commercial break.
It's fantastic.
I was talking about the piece from the FT.
Okay, yeah.
Okay.
About, like, sitting, skulking around, waiting for a shot.
Right?
Yeah.
This is quite a quote, isn't it? Memo to Wall Street, quit whining about the Federal Reserve. Your clients are paying you a lot to make judgments about risk and returns in real time. It's embarrassing when you complain now that Daddy Fed isn't telling you how to do it.
Yeah, if you were concerned about the tone of the Fed conference, well, this gives you a different kind of tone. I guess this is the counter argument, but my main take from this, and we don't have to get into it, is just the idea of forward guidance versus reaction function. And again, it goes to the idea of conflating both. And Torsten Slok put it well. It's one thing to say we're going to get there. It's another thing to say how long it will take and potentially what parameters you're using to get there. And if that's not given, then people just assume that you're either not going to get there or potentially just overreact to every single data point.
And that's what we've seen last week, potentially. This morning, equity futures doing better, up by 0.5 on the S&P. What a ride it's been in the US stock market over the last month or so. 2 days of gains last week, helping drive stocks advance on the week. On the month, we were down by about 0.1% on the S&P 500. Within that, a 20% move lower on chip stocks, 20% plus, the worst month we've seen for chip stocks in America since 2008.
There's an existential question here. On one point, there's the idea of strategic concepts, or the hedge fund that blew up, and how much that was situational awareness, how much that potentially could be contributing to the volatility. But then there's this question of, at what point do competitors create chips that are actually cheap and that are potentially rivaling these and that lower the potential 80+% margins that some of these companies are seeing?
That's the equity picture this morning. Here's the bond market move. Yields lower across the curve, down 5 at the front end of the curve. 2s down to 424, 10s at 468. If you turn to the commodity market, crude declining, Brent and WTI. Brent down by 5%. WTI back into the 70s, 79.70 so far this morning. And the Savannahs this morning, renewing hope for a deal.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. We're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that.
So here's the latest this morning. Oil plunging on developments in the Middle East. The president cancelling a planned attack on Iran, saying a fresh round of talks will begin today. Tehran denying any current negotiations with Washington. Stephen Cook of the Council on Foreign Relations writing, any way you look at the current state of play in the war, it is a strategic defeat for the United States. Stephen joins us now for more. Steve, welcome back to the programme. Is there any reason to believe we've broken out of so-called purgatory in this situation?
Well, it doesn't seem to be the case unless the president is prepared to capitulate. I think that the conflict over the status of navigation through the Strait of Hormuz will continue. Allegedly, the Iranians and the Omanis are close to a deal in which they have hammered out a two-way traffic in the Strait, but it doesn't suggest that the Iranians have given up on the idea of tolling traffic in the way in which they control navigation. So it seems to me that we're basically in the same exact place that we were in before the president's recent escalation, the same exact place we were in when he threatened escalation over the weekend and then pulled back.
Steve, you and I have been talking about this endlessly. You've talked to us on this programme for months on end as we've toggled between strikes and talks, talks and strikes, strikes and talks, talks and strikes. Stephen, what is it about the situation the US has got itself in that is proving so difficult to break away from?
I think there's really two things. One, the Iranians are willing to absorb a lot of punishment in order to control the Strait of Hormuz. Two, the United States has demonstrated over and over again it is not willing to escalate. The president has over and over again threatened the Iranians only to, at the last minute, claim that negotiations are underway, there's a new regime, or our Gulf partners have said, hey, this is not something that we can tolerate because of the damage the Iranians are willing to inflict on us. So that is how we've gotten to this point where there's been no progress and the Iranians continue to control the Strait of Hormuz, a situation which is a step back from where we were on February 27th when there was freedom of navigation in the Strait.
I read a number of articles over the weekend, Stephen, with a lot of hand-wringing about how the U.S. has lost its role as sort of controlling international conflict in the same way that it had been in the post-World War II era, and that this feels like it's spiraling out of control with respect to the number of actors getting involved. How much is hyperbole and how much is true?
Well, I think there's a certain amount of hyperbole here, but at the same time, you can't look at this situation and not understand that the United States' deterrence has eroded dramatically, and our global competitors are watching this. If the Chinese are interested in how the United States keeps a waterway open, this is an exact lesson on how not to do it. The president has backed down over and over again. That's not a suggestion that the United States should escalate, but if you're going to threaten it over and over again and back down over and over again, it is going to erode your ability to compel your adversaries to do things.
There's a potential for a lack of ammunition. That's something people have talked about. One reason why the U.S. might not be escalating. Then there's this issue of what it's actually going to accomplish. I was reading some notes saying that essentially all that's been accomplished has been already from airstrike perspective, and to really do more, they would have to put troops on the ground. To what degree do you see that as a reality?
Oh, certainly the interceptor issue is a problem. The U.S. military has said that in the event of a renewed conflict between Israel and Iran, the United States would be unable to help defend the Israeli airspace. The president has ruled out ground forces, but really, if you want to keep the Strait of Hormuz open, you're going to have to land troops on the shores of those islands as well as the northern shore of the Strait of Hormuz. That is something that was, I believe, was in the original war plan, but that the president rejected that.
And still waiting to see if he follows through. Stephen, thank you. Stephen Cook there, the Council on Foreign Relations. As things stand this morning, we're back to talks again and crude declines. We've had a massive range on crude in just, 2-3 weeks? We're down 5 or 6% this morning. WTI is back at 79. Brent crude in the low 80s. Let's call it a $20 range in, a week or two on crude?
I don't understand how there can be liquidity in this market to the same degree, how people can have any conviction to trade when you have this whipsaw experience every single day, when you have a 6 to 7% either gain or loss one day to another. It just highlights, last month, this was the best performing asset, right? Up 24%. But my goodness, was it a jagged path, and it really leaves people queasy and uncertain of really involving themselves.
Why are people finding it so tedious? They're finding it tedious because nothing's really changing. This is why it's so uncomfortable. We've talked about this endlessly on this programme. This is the new normal, just toggling between talks and strikes, with no clear break and no real path to break away from this situation we're in.
It's an era of supply shocks, and people are looking at this and saying this is the new normal. We've talked about that. If this is the new normal and potentially sets a precedent for that, what's the likelihood of ongoing supply shocks that cause prices to rise in sequential manners, even if in different areas?
Crude down 5, back in the 70s on WTI. Up next, Jeremy Stretch of CIBC as the US and Japan join forces to boost the yen. From New York City, you're watching Bloomberg TV. to build on 2 days of gains on the S&P 500, building on that rally this morning. We're higher by 0.5 on the S&P, up by a third on the Nasdaq. What a ride it's been on the Nasdaq and for tech, particularly for chip stocks. We talked about that monthly decline for chip stocks. Semis down by more than 20% through the month of July, the worst month going back to August, going back to 2008, which is just crazy, just absolutely crazy. Switch on the board and get to the bond market. 2s, 10s and 30s. Yields shaping up as follows. Yields declining this morning. We're down by 5 basis points. I just wonder how much the Japan situation is helping out the bond backdrop, and we'll spend some time on that in a moment. We're down 5 basis points on 10s to 4.68, on 2s to 4.24. Certainly this move in crude is helping as well. WTI and Brent. Brent crude is down by 4 or 5%. We're down close to 6 on WTI. 79.74 on WTI this morning. Brent crude 83.80, and the swings, the wild swings, continue.
What's notable is that last week we were talking about how oil swings weren't having as big of an effect on the bond market. Suddenly they're having that much more when they're also being coordinated with yen intervention that led to the Japanese government bond market being one of the best performing last week. You actually saw yields come in a basis point at the long end in response to some of this intervention. Again, it goes to, are we in a free market? Not to be existential, but I was thinking about this morning. How do you situate a portfolio when you have a potential bazooka up against you at any time? You don't know when to do it. And this is partly by design, right? This is part of the goal of some of this intervention is don't short some of these currencies because we could come in and mess up your plans. Nonetheless, it does introduce another layer of volatility.
I have struggled with that question in Japan for a long time. I don't think it's much of a market and hasn't been for a long time because of the central bank involvement in the currency and in the bond market that's built up over the last 10 years, 15 years for that matter.
But this market is having a bigger effect on the rest of the world, and that's what I think is different. And the intervention coming from other places because they are so worried that the money coming from Japan could come home or potentially leave their bond market. Either way, it could really hurt what happens here in the U.S.
Dollar yen this morning, 157, just a little bit more yen strength. 3 hours away from the cash open. The opening bell just around the corner with your morning move is your single names. Yahara has more. Hey, Yahara.
Hi, John. We start with the possible pharma deal. AstraZeneca and Bristol Myers moving in opposite directions as we in the FT report that the companies have held early stage merger talks. And this could be significant if a deal ultimately comes through. It would create the world's biggest drug maker by revenue. But as you can see, the market is not convinced. And that's because Astra has one of the strongest pipelines in the industry, so investors are questioning why it needs Bristol at all. Meanwhile, we are seeing Alibaba ADRs rising 4.5% in the pre-market after the company unveiled its biggest AI model yet, calling it its most capable yet. That's that it delivered comparable or sometimes better results than Anthropic's Fable 5, which of course is one of the world's most advanced AI models, and outscored the breakthrough Kimi K3 in several internal benchmarks. And just speaking to the risk-on mood that we're seeing in markets, we are seeing the hyperscalers, Amazon and Google, rising in the pre-market, enjoying the tailwinds after last week's stellar earnings that show that their AI investments are paying off. And Goldman Sachs' Ben Snyder is out with a note overnight saying that dynamic could help calm some of the volatile swings that we've seen in AI stocks as of late. And obviously Meta has been the wild card, though it is continuing to recover after last week's big sell-off. John.
A few members of the Mag 7 making a comeback. Yahara, thank you. More from Yahara in the next hour. On our radar this morning, President Trump saying new talks with Iran are set for this afternoon after cancelling planned strikes, suggesting a deal to reopen the Strait of Hormuz could be close. Tehran denying negotiations are happening. Elsewhere, Fed Chair Kevin Warsh considering cutting back the number of yearly Fed policy meetings. Sources telling us here at Bloomberg, Warsh is floating the idea of meeting 6 times a year to decide on interest rates and 2 times for discussions on big economic topics. And finally, the US and Japan joining forces to boost the Japanese yen.
We have a good relationship with Japan. We're very strong, very, very strong financially. They wanted a little bit of help, and we're always there for Japan. Japan's been very good to us.
with one exception, which the president was keen to point out, but we won't go there. Officials from the two countries not ruling out additional intervention.
Yeah, Scott Bessent went out on X last night, Treasury Secretary Scott Bessent, and said the Trump administration delivers for America's trusted partners. Economic security is national security, and the U.S.-Japan alliance is built on both. He went on to say that they are prepared to act against more disorderly yen movements, which is part of the reason why you are seeing a follow-on move this morning. Also reportedly on Thursday alone, the finance ministry of Japan injected some more than $50 billion of currency intervention into their market. Again, you have to go back to where are they getting this money? They are selling Treasury holdings in order to raise the cash in order to do this. If the U.S. gets involved, they can sell down some of their euro holdings in particular and transfer them into yen-denominated holdings, which gives them a potential influence over exactly what that valuation is.
Which, according to the FT, is what went through the New York Fed into the weekend. You've touched on an important dynamic. We've been talking about it throughout this morning. It starts with a central question. Why does America care so much? Let's park the friendly stuff and talk about the reality of the bond market. Let's talk about our world. There is a strong belief this morning that the US cares so much because they're worried about two policy efforts materializing and building up. One is that Japan has to sell its Treasury holdings. They are the biggest Treasury holdings on the planet. You don't want to see those declining if you're Treasury Secretary Scott Bessent. And two, you certainly don't want to see Japanese authorities begin to promote, maybe even encourage and regulate the repatriation of capital from abroad, which leave the US bond market and others too vulnerable. This is a global bond market. The Treasury market is exposed to it. There are factors in Japan that are very unique that could contribute to high yields. It is of concern because we're seeing the list of reasons for high yields grow longer and not get shorter. And we've talked about this after Wednesday's policy move from this Fed, that of everybody watching those moves, and we talked about Wall Street being unhappy about forward guidance, forget that. I was thinking of the Treasury secretaries. I was seeing yields start to fly higher at the long end of the curve. That's a man that might be concerned, and I think he was concerned going into the weekend.
Treasury Secretary Bessent is not one to waste a crisis. And if those moves were going to help facilitate this intervention, well, it's a great time to do it. It sort of strikes me of his experience in the markets with currency over the years, whether it's with George Soros or whoever else, and understanding that sometimes when the iron is hot, you got to strike.
Valuable experience. Did you see that note in
I
Reuters,
did.
that picture?
5 to 10 billion.
He's done this before.
Really?
He was being asked about it, and he says, I write it there because I know you'll read it.
That's
right?
good. All right, so there you go. I mean, obviously. I mean, nobody writes notes themselves
Market moving
like that.
notes in a cabinet meeting with the press sitting over your corner.
Yeah, I mean, what do you think?
Come on, he knows what he's doing. Jeremy Stretcher, CIBC, writing, compared to the April-May interventions, the latest round arguably carries more weight because of the coordinated moves by the US Treasury. Jeremy joins us now for more. Jeremy, there are some underlying problems in Japan. There is a term of trade shock, and welcome to the programme, buddy. It's always good to see you.
Good morning.
You're facing a terms of trade shock that oil has contributed to. You've got deficit issues as well, and massive rate differentials with the US. Why does this intervention help them fight those three?
Well, indeed, you are talking about, in effect, a containment policy, because unless the oil price is going to come down materially, or unless the interest rate spread between the US and Japan closes exponentially, and that would imply that the BOJ would have to bring forward, not only bring forward their policy tightening, but be more aggressive and perhaps the market reprice the Fed expectations, it is seemingly more of a containment issue. But I've just been listening with great interest to your discussion with Lisa regarding the holdings of treasuries by Japanese investors. And I think that is particularly notable. I think that twist steepening that we did see in terms of the US curve after last Wednesday's Fed decision, I think was also notable. And I think if we go back to Liberation Day and the post-Liberation Day period, it was the discipline of the bond market that really exercised control on the politicians. So I think it is that sort of bond market dynamic that I think is proven to be contingent here in terms of this broader narrative regarding the dollar-yen exchange rate.
Jeremy, just to take that a step further, how much is the timing kind of predicated on the move that we saw following the Wednesday Fed press conference?
Well, certainly, I think the two are not inconsistent in terms of the timing dynamic. So we have seen, obviously, a consistent grind higher, or had seen a consistent grind higher in dollar yen through the month of July. But clearly that's risked, there was an increasing degree of concern or destabilization, perhaps in the bond space after that Fed decision. So I think that did amplify concerns. And in a sense, it is an opportunity to, to try and hit a market which is very extreme in terms of its positioning. I think it was very notable that if you look at yen short positions, they were the most extreme in 2 years, and indeed were pretty close to the levels that we haven't seen since 2007. So the market was pretty stretched. There was a degree of volatility or a degree of uncertainty which had been unleashed in terms of the Treasury curve, in particular after the Fed guidance narrative. So I think those two things certainly coincided to provide perhaps a fertile ground into the month end for the authorities to try and come in and hit a market which had been heavily skewed in one direction.
This is incredibly rare, Jeremy. We were talking about how the last time there was some sort of bilateral coordinated currency intervention was 2011, when at the time a number of nations coordinated with Japan to help depreciate their currency. Then before that was 2000, when the U.S. and a group of other nations helped support the newly formed euro when it was depreciating. Do you think that interventions like this are going to become more frequent, given what we're seeing now with Japan, given what happened with the credit line to Argentina, given some of the rhetoric that we're hearing out of the Trump administration?
Well, again, I was listening to your discussion earlier when you were talking about free and fair markets, and in a sense that does beg the question that intervention or the prospect of intervention certainly creates uncertainty regards the sort of the free floating nature of both currencies, but also the free flow of information and the market reactions accordingly from that. So I think there are degrees of concern in relation to the current environment, and I think there is going to be increasing skepticism as to whether there will be some degree of increase in official action going forward, and that could create additional pockets of volatility and or uncertainty. And I think that's the subtext here, and I think it's quite interesting to to tie this with the forward guidance debate and discussion that you've been having for some time, and in relation to Mr. Warsh and etc. I think we have to remember that we are in a new world, or at least for many market participants, we're in a new world, because I've unfortunately been around more than long enough to remember pre-forward guidance, and perhaps many in the market have yet to understand the ramifications and the uncertainties that could come with that.
It looks like we're going back to that world. Jeremy, it's good to see you. Jeremy Stretch there of CIBC.
Thank you.
On Japan. On Japan, I consider this as changing the volume of the music, but not changing the track. The mood music is exactly the same. They just turn the volume down. That's how I look at this situation. That's how I view intervention. It's very difficult to do this every single day, to convince people not to trade a currency in a certain way, but the fundamentals are against it in the way they are.
Well, ultimately, it has to come with some sort of reaction from the Bank of Japan, and we're going to get the meeting minutes later this week from the previous meeting. Do we get a sense that they are ready to go sooner than September, and potentially even more aggressively than September? And frankly, it has to go to fiscal questions. The fact that Prime Minister Takaichi is as involved as she is and as close to President Trump, you wonder if there are going to be certain fiscal prescriptions on their end to help fortify this.
Because this is what's happening in the polls right now for Takaichi.
Yeah.
Right? As a consumer, you're getting hit by higher energy prices and a weaker currency. None of that's going to help you in the polls.
Yeah, but the problem is that typically what has been winning in the polls is to provide more services, to do more, to provide more for potentially fewer tax dollars coming into the coffers. So how do you then rein that back to convince the currency markets to then give more strength to your currency that could potentially lower inflation, that then actually improves the quality of life for your constituents? It's a more complicated message, and complicated messages don't fly politically.
4-day, 4% move in the yen's favour. Dollar yen down to about 157 this morning, with an update on stories worldwide. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Alibaba releasing its latest AI model ever. Trend 3.8 Max is said to be on par with Anthropic's Fable and ranks higher on several benchmarks than Moonshot's Kimi K3. The model is the latest in a string of Chinese tech firms pressuring US rivals. Europe's biggest rivers are drying up after the summer's blistering heat waves. Extremely low levels of water on the Rhine and the Danube are disrupting transportation of goods and curbing power generation. The continent's fourth heat wave is set to stretch through most of this week. Spain says nearly all 50,000 migrants who illegally crossed into Ceuta last week have returned to Morocco. EU ambassadors will hold an emergency meeting to discuss immigration, with some countries set to push for tougher policies. And that is your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update. Up next on the programme, keeping markets in the dark.
There really was virtually no information about how the Federal Reserve is thinking about monetary policy. The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. He's overpromised and underdelivered.
Up next, Mark Cabana of Bank of America. Lisa's very upset that Daddy Fed is no longer providing guidance.
I'm crying.
Just to clear that up.
Yeah, exactly.
Distraught, in fact.
It's
surprised you made it to work this morning.
It was tough. It was a tough weekend. I dressed in black the whole weekend.
Oh, did you?
Yeah.
This morning?
And I just stared at the wall.
Mourning the death of forward
exactly.
guidance.
It's sad. It's a sad, dark day.
Equity futures this morning doing okay, bouncing back by 0.6%, adding to a two-day winning streak into the weekend on the S&P. And the bond market yields declining across the curve. We'll talk about fixed income in just a moment. We're down 5 basis points on 2s to 424, down 5 on 10s to 468. Under surveillance this morning, keeping markets in the dark.
There really was virtually no information about how the Federal Reserve is thinking about monetary policy. It's weird when you're not explaining why three people are dissenting. The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. He's overpromised and underdelivered.
So here's the latest this morning. It might get quieter. Fed Chair Kevin Warsh floating the idea of fewer meetings. Sources telling us here at Bloomberg, Warsh is discussing the idea of meeting 6 times a year to decide on interest rates and 2 times for discussions on economic topics. Mark Cabana of Bank of America looking forward, writing, the Fed now has a credibility issue to deal with. We believe they will want to regain control of the narrative. Mark joins us now for more. Mark, good morning.
Morning.
Are you upset that Daddy Fed's no longer providing guidance too?
No, I'm not upset about that. I just want to understand what the reaction function is, and I want to understand what is the justification for any decision that they make. It's fine that you don't have to tell us exactly what you're going to do, but the analogy that we were discussing earlier is if I tell you that I'm going to lose weight and I'm going to lose 15 pounds, then you're going to want to know how I plan to do that. And if I tell you that I'm not going to do it through diet, exercise, or GLP-1, then you're going to have to question how committed am I to actually doing this. And that is exactly what the market is doing right now for the Fed. It's wonderful that you're resolute in your determination to have 2% inflation, just like I'm resolute to lose weight. But unless I tell you how I'm going to do it, we will not believe you. And you can't fool the bond. You can't do it. The bond will see through it, and that is our interpretation of what happened last week. And if this continues, the bond will continue to reflect a greater inflation risk premia and more uncertainty. And the only one who's going to be crying will be the taxpayer, because it means higher associated costs and likely wider bid-offer spreads. So it's really a choice for the Fed. We're not crying because we need the forward guidance. We are looking for a plan, and we don't see one right now. And that is what the long end of the rate curve is telling you.
If Kevin's watching this morning, good morning. That felt very personal. Can we talk about the Federal Reserve equivalent of diet, exercise and GLP-1s? Interest rate, balance sheet, or just sit there, do nothing and wait? Which one is it?
Well, tradition would suggest that it's the front end and it's the overnight rate. That is the Fed's most widely known tool. It's the tool that they have the most comfort with, and it's the tool that they can map for the longest period of time. On the balance sheet, there's just not that much they can do. And if anything, what we've learned over the last 24 hours with all the yen intervention is that, if anything, the Treasury Secretary wants the Fed's balance sheet to grow through the use of the FEMA repo facility. So how is this going to translate into getting inflation lower? If anything, what would happen is that if the Japanese authorities use the FEMA repo facility, you're adding more dollar liquidity into the system, you're putting downward pressure on interest rates, and that is ultimately allowing for inflation to become even more deeply entrenched. So, traditionally, it's been the overnight rate. That's what we all continue to think that the preferred tool will be. The balance sheet, they're going to struggle to get it down. There's very few things that they can actually do in order to bring the balance sheet down outside of bank liquidity deregulation. And then beyond that, I'm not exactly sure. You can sit and hope and wait, but hope and wait is not a strategy. The market needs to see action. Otherwise, we're going to continue to believe that inflation becomes more deeply entrenched.
It's unclear whether the rest of the Fed committee is on board with this strategy of just silence. And clearly, we're not getting silence this week. We're getting the Fed's Schmidt coming out on Tuesday. On Wednesday, we get Lisa Cook and Mary Daly. We get Alberto Musalem on Thursday, and then Tom Barkin on Friday. A lot of Fed speak. How much louder will their words be with the absence of Kevin Warsh's words filling the space?
We're banking on them being louder. We're banking on the rest of the Fed trying to reestablish some of the inflation credibility that we perceive was lost last week. And if Warsh is not going to be the one that gives us the plan for how this goes, we expect that the rest of the committee will begin to fill in that gap. And we do think that we're going to hear more individuals at the Fed that talk about how they perceive it's important that rates be higher because they don't want to see this type of inflation credibility hit continue to grow. They don't want to see longer dated inflation break-evens continue to widen, which is exactly what we saw last week. To us last week, it was a textbook inflation credibility shock. You had nominal and real rate curve steepening. You had inflation break-evens widening. You had the dollar weakening. You had equities lower. You had this classic credibility shock. And we expect that the rest of the Fed will lean against that and provide more insight into how they are thinking, what they want to do about it, and then when they think it's appropriate to start raising front-end rates.
Someone could argue, potentially in the Wall Street Journal in an article calling us all crybabies, that potentially the rates being where they are on the long end is a result of economic activity accelerating, AI investment, the fact that the economy is strong, and to the degree that it overshoots, it will naturally constrain economic growth and do the job of constraining inflation. What do you make of that argument?
So I do believe that rates are relatively elevated because we do have extremely strong U.S. growth and we have a period of very large inflation for which there's still some increased inflation risk premia at the long end. To say that I'm not going to do anything and I'm going to let the long end essentially build in more inflation risk premia, have that tighten financial conditions and weigh on the economy, yes, you can get there, but it does come at a cost. It comes at a cost of, well, I don't see a central bank that is taking action. I therefore think that inflation is going to be higher, and I'm going to bake that into my business decisions in the future. And that is the cost that goes along with it. It also runs the risk of more volatility, and that means wider bid-ask spreads. And I just don't think that that is the most efficient way for a central bank to handle this. But if the Fed does not respond, we will see more of that at the very long end of the curve. And that's just been a very non-traditional and arguably much less efficient way of conducting monetary policy.
Mark, 45 left on the clock. What are the data points that will keep this Fed call alive for you, the September hike, and how do they need to come in?
So Friday matters a lot. And we think that in the employment report on Friday, you're going to see 80,000 headline, you're going to see 95,000 private, you're going to see an unemployment rate that ticks back up to 4.3 simply because the participation rate is expected to go back up a little bit. But generally speaking, a labor market that is running like that to us still has risks of further strengthening. You're running above measures of the monthly break-even rate of employment growth, given all the demographic and population change, especially with immigration changes that we have seen. And we do worry that that's going to continue to allow for a very strong economy, labor market that is at the risk of showing a further tightening and upward wage pressure. And if that's the case, if that data holds, we do think that that'll be consistent with a hike in September. Inflation will be the other key data point, but really this week it's all about Friday. And a print that comes in line with consensus, we think will be very supportive of a hike in September.
Mark, appreciate it. It's good to
Thanks
see you.
for
Thank you,
having
buddy.
me.
Mark Cabana there of Bank of America, looking ahead to payrolls this coming Friday.
Mark, you don't need to lose weight, so I think you're fine just the way you are.
Doing great,
just saying, you're doing great. But it's I love the passion though, and it highlights kind of how people are looking at this in a very rational and unemotional way.
I thought he was talking directly to Kevin at one point, like down the barrel of the camera.
I think.
Felt personal.
I mean, you know.
Coming up next, we'll catch up with Sarah Hunt of Alpine, Saxon and Woods, Colonel Wayne Sanders of Bloomberg Intelligence, Sarah Kunst of Cleo Capital, Neil Dutta of Renmac.
The commentary from the Federal Reserve obviously has given a lot of people some indigestion.
People are more worried about the Fed's resolve to do the job.
The data is going to be important over the next couple of months.
I do think the economy is doing well.
The economy is strong. Inflation is pretty healthy, maybe even overheating a little bit.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action, your scores look like this. Equity futures adding to 2 days of gains on the S&P 500, higher by 0.6. On the Nasdaq, up by 0.4. In the bond market, yields declining off year-to-date highs. On twos, we're back down to 423. We're negative 5 or 6 basis points on the session across the curve. Helped out by this move in crude, WTI and Brent down by 5 to 6% for much of this morning. Brent around 83, WTI at 79. And helped back by this too. Check out dollar yen this morning. 4-day move, 4 percentage point decline in the yen's favor. Dollar yen back down to about 156 so far this morning.
This comes after the yen had weakened some of the lowest levels that we've seen versus the dollar going back some 40 years. And already we had seen the finance ministry of Japan intervene with billions and billions of dollars that were spurred by what? In terms of how are they financed? And it was financed by selling U.S. treasuries to get more capital, to get into their market to try to support the yen. We talked and joked about how this was burning capital, but now the U.S. is getting in on it and saying, okay, we're going to help you out. And the question is why? The U.S. is now selling euros and buying yen in order to support the currency at a time when you see the administration talk about friendship, collaboration, security. A lot of people are saying, look at the long end of the yield curve and you'll get all the answers you need to know.
Yeah, this has nothing to do with friendship and everything about this. Bring up the yield curve. Everything about 5% on 30s plus and approaching 470 on 10s. That's what this is about. Look across the curve this morning and think about what's contributed to all of this. Fed credibility is a factor, sure. Additional supply coming from here, there and everywhere, without a doubt. But the global backdrop, the very fact that JGBs were once an anchor around the neck of this bond market, and that anchor is away. Yields are higher. And the fact that they are now facing down a currency shock, a terms of trade issue, widening rate differentials, and they need to do something about it. And there's only one lever. You sell treasuries, and that's a problem for this treasury, given the backdrop for this fixed income market.
Is it a coincidence that the 30-year yields in the U.S. reached the highest level going back to 2007, the same week that the U.S. helped the Japanese intervene with their currency to support, create a ballast, create a ceiling or a floor for how low it could potentially go versus the dollar? Going forward, there are going to be some really key constraints here, because you were saying what else can they do other than to pull this lever? There are things that they can do, like hike rates, like potentially constrain some of their spending. Question is this action by the United States contingent on some domestic actions to fortify this move other than just intervening in markets?
Well, let's talk about what they can and what they're not willing to do. What they can't do, they clearly can't have an energy revolution anytime soon in Japan. So they're going to be importing energy, importing food. That's a problem. They clearly have no willingness to hike interest rates aggressively, which is why rate differentials have gapped out to the extent they have. And there is obviously an unwillingness to do something about the budget deficit anytime soon, too, based on what we've seen domestically in the politics. So what do you have left? Either you do something aggressively on currency intervention, which weighs on treasuries, or you start to encourage, promote, possibly even regulate the repatriation of capital and bring it all home, which would once again cause some problems in the bond market.
Yeah, and again, none of these things are solved. This is an important note to make, which is that we haven't resolved any of those issues. All we've done is bought time. And so now the question is, how is that time used? Last week was a seismic week. We really have to underscore that. Not only did we get the biggest intervention possibly going back decades, and the first in this type of manner going back to 2011, we also had the unwind of a massive hedge fund of a situational awareness that affected a lot of the chip stocks in that region that helped a lot of tumult. We also had a Fed decision that allowed long-end yields to go up. You can argue why exactly, but a lot of people are saying it was a loss of credibility and inflation expectation shock. This has all led to a lot of seismic interventions. And again, I keep going back to the free markets versus actual markets, because at a certain point, how do you bet on things if you know someone else is going to come in and put on the stop button, regardless of whether it's coming from the Fed or Treasury when things get out of control?
I prefer the Ken Griffin style intervention, right? Leave it to the markets to sort out themselves.
The Grim Reaper?
That kind of intervention.
Are you going to be the Grim Reaper who calls up? I love that description by Cliff Aston.
I wish I was in Ken's position to be able to do that, but unfortunately I'm not. I mean, that's a guy that can afford to buy dinosaurs and store them wherever he likes. So no,
we didn't know who bought that dinosaur.
Well, he's bought dinosaurs previously,
That's
right?
true.
Or a dinosaur. So, yes, you're right. We've got all these little points of tension and all these little points of intervention. I remember a piece from Mohammed El-Arian a long, long time ago, and he talked about all these little fires starting to come out. There's a lot of little fires starting to come out. There was one missing that you didn't mention, South Korea, which I think probably contributed to the move that you saw in situational awareness
Yeah,
too.
and which beget which, given some of his positioning. But yeah, there are a lot of little fires. At what point do they come together to have a conflagration?
Just a blaze.
Yeah, or is this just going to be little fires and it actually controls the underbrush?
Yes, there you go. Maybe. Doubtful. Possibly. Yields down this morning. We're down by 6 basis points. Tens about 467. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods. With stocks hovering near record highs, Sarah Kunst of Cleo Capital, as SpaceX prepares for its first public earnings report, and Neil Dutta of Renmac, as Fed Chair Kevin Warsh weighs changes to policy meetings. We begin this hour with stocks rising following the weakest July performance in over a decade. Sarah Hunt of Alpine Saxon Woods writing, the absolute growth in S&P 500 earnings for 26 remains driven by information technology and communication services. So hopefully the earnings growth story can continue. We hope, Sarah. Good morning. Good to see you.
Good morning.
Has a 0.13% decline in the S&P ever felt this bad?
It has not. There is an absolute, I think that this is one of the things where the indices are moving in ways that belie the underneath the tumultuousness, wow, my words, tumultuousness under the surface. I think there are a lot of sector moves that are going back and forth. I mean, you saw the Procter & Gamble news. The reason I mentioned that on the earnings is because staples are not in great shape. Here's where you're starting to see that margin compression. You're not seeing it yet in industrials. You're not seeing it yet in technology. But that's the kind of thing where people are starting to say, okay, you can't keep pushing price forever. And that's where you start to get some problems. So I think that there is a lot more movement than the headline indices would suggest.
Who has pricing power and who doesn't? We thought chips had pricing power, then chips just went on a massive round trip. But a 20% plus decline on the semis last month. I mentioned earlier this morning, biggest monthly decline. I think I said August, it's October 2008. Still, it's 2008. It's been that long. Semis went vertical and then they crashed. What are your thoughts on that sector now? The pricing power, the sustainability of the earnings stream, the pricing, the valuation of that story too?
I think the valuation is still something that's a little bit challenging even after that crash, just because of how parabolic they went. And I think that the expectation was these things can continue on this trajectory in a linear form, which is the problem, I think, historically, is that we all tend to think in these linear forms when things start to go in our direction. And for the continuous interruption of coming out from China and saying we can do this cheaper, we can do that cheaper, it takes away from that story. Now, in the end, do we still see a lot of capex? Yes. I think the Amazon and Microsoft numbers were very important last week. And I think that if you talk about reasons for the market to have turned back around and feel more comfortable, that huge increase and acceleration in demand for cloud was very important to all of the story, because it says we still need to keep buying. But whether or not you can price infinitely higher forever is clearly, I think, a question, and I don't think you can. But I also think that things got away from themselves, and usually you don't look at those stocks when the earnings are continuing to accelerate. You look at those stocks when those price-earnings ratios don't look so good. So I think that there's a little bit of a tension there. But definitely that demand picture that we saw last week from earnings was very helpful to the story.
Yeah, well, the hyperscalers clearly seem to be like winners once again, and a lot of people are in particular going on to Amazon and Microsoft to some degree this morning, Google as well. From your perspective, how much was this completely a result of situational awareness? Was a lot of the volatility, particularly in the chip stocks, over in South Korea, over here in the U.S., how much is a result of a little fire or a pretty big fire bailed out by Ken Griffin?
Well, that's the problem of things that interact like that, right? Because which is the chicken and which is the egg here? You saw an enormous amount of leverage use in Korea. You saw an enormous amount of single stock levered ETFs that were acting in the memory space. All of these things together work beautifully on the way up and horrifically on the way down. So that movement that we saw in June, where everything was moving higher, and even at the beginning of July, it wasn't so bad. I think once you get one trip in that system and it starts to come down, you see that leverage unwind. And I think that's what we saw. And that was very painful for a lot of people, including the Korean market. Besides the situational awareness piece, I'm sure that there are plenty of other places where there was a lot of trouble, but the question was it trouble that was existential like it was with situational awareness?
It also came when there was a breakout of an argument in Silicon Valley last week that really rocked the boat, and you saw truly everyone pitted against OpenAI Anthropic. OpenAI Anthropic saying we want these closed models preserved, we're hoping that regulation can do this, and you had the likes of Mark Zuckerberg from Meta, you had the likes of Jensen Huang from NVIDIA coming out and saying you're wrong, we need open models to compete with China because China right now is flooding the zone and they're actually developing technology that's going to be the leaders. How much does this potentially undermine the prospects for OpenAI and Anthropic? And that's kind of hanging over people, the idea that potentially these kind of frontier models are going to be rendered obsolete in some of their financial prospects.
Well, to some degree, there's a little bit of talking your own book, right? Because if I have a model that I want it to stay closed, then I'm absolutely going to come out in favor of that. If I'm struggling with that, like perhaps some of the other folks are, then maybe I don't want to espouse that so much. I think that it is still a frontier mentality where people are still running to stay in front and trying to figure out exactly how this is all going to interact. And I don't think we have the answer to that yet. And that's part of the problem with which way to go on the investment side, because you see people running this direction and then turning around and running in the other direction because you're trying to capture that. And right now it's difficult to figure out exactly how to capture that.
Lisa's making a really interesting point, and we were building on this conversation with regards to whether value will be created. Will you just see a commodification of the frontier model there? And maybe the money's made somewhere else in the infrastructure. I don't really know. I'm still trying to work that out in real time, and I'm sure you are too. Where do you anticipate the value will be made within the AI ecosystem?
Well, I think what you're still seeing, and this goes back to the conversation that's been going on for a year and a half, there's an ancillary trade to all of that, which is still building out the ecosystem. And there will be value there because people will use it. I mean, the question is exactly how and exactly who's going to get paid. But the fact that you saw that acceleration for the hyperscalers, I think, was an important part of the story. Had you seen a deceleration there, I think we'd be having a very different conversation. And when they started talking about CapEx and maybe not bringing CapEx down so much, but that second derivative is not nearly as strong and in some cases negative, I think the market wants to see a little backing off of CapEx. They're a little worried about how all this is going to get funded. So to the extent that you can bring that down a little without crashing the whole system or without crashing investors' expectations, I don't think that's necessarily a bad thing.
It was a bit sketchy at one point, wasn't it? These guys were being punished for spending, and the people who were getting the money from the spending were getting punished too. It's an odd month last month at times.
Well, I think that just says that people were worried about the sustainability of that, because the sustainability of saying I'm going to raise CapEx by 20 or 30% every year ad infinitum is not something that anybody thinks can be funded. And then you start to have those questions about, do I want to be in the debt side, the equity side? And if I can't do it with debt, can I really keep raising equity? And I think that there is a point at which it is safer for the market in general, but also it is better to have a more moderated pace of spending so that you can actually see that spending is worthwhile. And that's been the question all along.
Sarah, it's good to see you. Thanks for dropping by. Sarah Hunt there of Alpine Saxon Woods. I found the reaction to the collapse of situational awareness to be quite instructive. The willingness to find a convenient narrative for the weakness that we started to see in the tech story, to find an excuse to buy again. How quickly people jumped on that on Friday. Max Kenner, HSBC, we talked about his note almost immediately. News around the unwind of the AI hedge fund situational awareness gives markets a welcome narrative to justify the renewed sell-off in chip stocks in the past 2 weeks. Technicals are cleaner now. It creates a powerful backdrop for a positive reversal.
What was it, 18% that the Kospi was up in the wake of this in one day or something of that nature? I mean, it was the biggest one-day rise ever. And you wonder, is this healthy? Does this give people confidence, or is this more volatility as people search for the next winner in this trade? It is notable, the idea of people looking and going from one winner to another. And last week, the real winner was the hyperscalers, in particular, Microsoft, up 22%. You take a look at Amazon, up 17%. These are massive gains, even though Apple was down 7% and Meta was down 6.5%. So clearly, they're the haves and the have-nots. It's just unclear who those haves and have-nots are from day to day.
A reason for people to buy, looking for an excuse. Nasdaq futures this morning up by 0.3. Equity futures on the S&P up by 0.5. With an update on stories worldwide with your Bloomberg brief. Vonnie's back with more. Hey, Vonnie.
Hey, John. Thank you. The Senate announcing a bipartisan deal aimed at avoiding a government shutdown this fall. Senate Majority Leader John Thune plans to bring the measure up for a vote this week ahead of the chamber's scheduled August recess. Jefferies' run fund Point Bonita Capital is reviewing its exposure to commodities trader Radiant World. The review comes following reports of Radiant World allegedly providing invalid invoices and other documents to banks. Radiant World denies the allegations. FIFA President Gianni Infantino wants the Trump administration to help him keep his job. The New York Post reporting that Infantino scheduled private talks with Secretary of State Marco Rubio. The report comes as the FIFA head is under pressure to resign over his bid to sell the World Cup to Josh Kushner's PE firm. And that is your Bloomberg brief. John.
And Vonnie, thank you. Thanks for the update. Hard to know how to react to that story.
I think with the meme of Marco Rubio being handed this assignment.
I think he spent a little bit too much time in the States around sort of the epicenter of capital markets and power.
I don't think this ingratiates him with his European friends.
No, not at all.
And I think that UEFA is going to fight back that much harder as a result of potentially Infantino having a compromised leadership.
The latest on FIFA this morning. Up next on the programme, negotiating with Iran.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies ask to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal.
And guess what's happening in the commodity market? Crude down. WTI and Brent up next. Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. Stocks doing better, up by 0.6 this morning on the S&P 500. 2 days of gains into the weekend, a weekly advance on the S&P, a monthly decline. That monthly decline down 0.13% on the S&P 500 last month. It felt so much worse. And for much of the month, despite this massive churn beneath the surface, we were within 2 to 3% of all-time highs. We are within 2% of record highs this morning.
In some ways, is this a feature or a bug, right? Some people will say in some ways this volatility makes it an incredible headache and positioning that much more important to get the positioning right. In other ways, people will say this speaks to the strength of the U.S. market. You can have lots of little fires in lots of places, but they even each other out, and at the end, you retain the positivity. The real question is, do you see the momentum in the underlying economy? And if that starts cracking, the story changes very significantly, which is why everyone's looking to payrolls Friday.
If I told you, I love that game. If I told you at the start of July, 20% decline in chips, where's the index? Index unchanged might not be the call people would have made.
Yeah, right now people are fleeing from one corner of the tech trade to another, and you can see that with some of the hyperscalers gaining almost same amounts that the chip stocks have lost. The question is, are we just having a ball of money that's rotating around? At what point do people make a decision as to who the winners are going to be? When does that kind of play out? That's why I actually think that the SpaceX release of shares and earnings are going to be really important as a predecessor to what we could potentially get from OpenAI and Anthropic.
They staggered into the lockup. More on that with Sarah Kunst a little bit later. Let's talk about this bond market. We do have an index level headwind coming from fixed income. Yields declining this morning. That's some better news. Down 6 basis points, 423 on 2s, on 10s down 6 as well to 468. The move in Japan, I think, contributes to this. Just removing that threat, that imminent threat of selling more treasuries for now to cash in and buy the Japanese yen in Japan. With dollar yen coming back down to about 156, that coordinated effort, it's very clear that we have a Treasury Secretary in the know who understands what's happening. Keir has a line of sight and is doing his best to keep yields down.
How much is the fact that the finance ministry over in Japan sold some $50 billion worth of treasuries on Thursday alone to support the yen? How much did that contribute to the fact that 30-year yields in the U.S. rose to the highest level since 2007? I'm not saying that there's a direct correlation, but you put all the moves from last week, the volatility coming from situational awareness, what we saw from the Federal Reserve, the lack of guidance, some of the hotter-than-expected inflation reads, and then all of a sudden you get this move in the yields, and then the intervention comes. You have to wonder how interconnected
I'm pretty sure Leopold wasn't long treasuries, was he?
No, he wasn't long
treasuries. That's far too vanilla, right?
No, but the U.S. story is an AI story. So
I'm with you.
I think that you can make the argument that it's connected. I mean, also liquidity, and a liquidity draw if you get that, and who else is going to have a fire?
Without a doubt.
Without a doubt. Yeah, I don't think that he's particularly interested.
Returns crude, down 5% this morning, make it 6 on WTI, back in the 70s on WTI, 79.70. We've got some talks to talk about. That's fun, isn't it? It's Monday morning, so we might as well. Under surveillance this morning, negotiating with Iran.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. We're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that.
So here's the latest this morning. Crude falling as President Donald Trump says talks with Iran will start today. Tehran saying it is not currently negotiating with the United States. Colonel Wayne Sanders of Bloomberg Intelligence joins us now for more. Colonel, welcome back to the program. We've struggled with this now for weeks and months, going back 5 months, struggling to break out of so-called purgatory. Do you see any conditions whatsoever that would stop these talks from shifting back to strikes once again?
Yeah, not really. I think that this is more of the same at this point in time. I think the allies that President Trump's talking about being able to pull away from the strikes is a good thing in terms of being able to create some solidarity around the GCC and being able to push that more in terms of a Middle East problem. So I think that part is good. The problem that I run into, though, is that right now, you know, every time that President Trump does this, his threats are now starting to fall a little bit on deaf ears when it comes to that because he is pulling back. But at the same time, the U.S. can't seem to get to the negotiating table without Iran coming back and striking with additional missiles, right? So neither side seems to be breaking free of this, hey, I don't trust the other concept that they're in right now.
What is the variable, Colonel? What is the metric that's leading the president to one day say it's talks and the next day say it strikes? Is it the price of crude, the stockpiles of ammunition? What do you believe it is?
I think that geopolitical does play a part in this, but I also think it's also military opportunities, talking to the CENTCOM commander, Admiral Cooper, and others as well, and saying, OK, all right, right now we have these on the Joint Integrated Prioritized Target List, the JIPTL, which is these are the targets that you have available right now. You also have what are called restricted targets, which they could potentially open up, which are a little bit more obviously operational risk involved being able to use that, right? So when he starts looking at that and he talks about a strike that's up to, the standards of World War II, is what is going to be the gain at the end? So they will war game this through most likely course of action, most dangerous course of action. They'll do what they call action, counteraction, and reaction. So they'll go through all of this and say, what are we going to get after this? And so at this point in time, I don't know whether or not those military targets are reaching that point where it's going to have the strategic gain that he wants.
Colonel, another way of looking at this is, have all of the likely targets that can be hit through airstrikes already been hit? I mean, what's there left to do in that manner? Or is all of the essential, have all of the targets already been stricken?
Yeah, I think a lot of the military targets have, and obviously restrike, they still obviously follow around additional, whether it's anytime they ever find any missile launchers or anything like that, those are going to be targets of opportunity that they follow around. Those are going to be primary strike targets. But then when you start looking at those higher operational risk targets, they do a center of gravity analysis, and they say, okay, if I hit this bridge, this is going to be the gain that's going to come, but there's also going to be some type of political blowback that could potentially come from that. And you have to start looking at that as well. And that's one of the biggest pieces that they've started to look at. You've heard President Trump talk about whether or not it was going to be some of the power desalination or even the bridges as those areas. But it has to be proportional. You have to be able to say that there was a military benefit to it that was greater than the harm that was going to be caused to the population, and that's one of the hardest pieces to get on the public stage.
Colonel, is there any takeaway as to what the future of war looks like based on this conflict and the one in Ukraine? Is there any kind of takeaway about the modern contours of war?
Yeah, absolutely. I think when you look at drone warfare alone, and then you start looking at counter-drone technology as well as anti-ballistic missile technology, you're seeing a lot of that across defense primes. You're seeing it on the global stage as well. You're seeing it from everybody from MBDA and Thales and others and BAE systems over in Europe, as well as obviously the defense primes with RTX, Lockheed, Northrop, and everybody here in the United States as well, looking for lower cost munition solutions, right? So what they call LCCMs, lower cost containerized munitions, are one of the things that people are looking at because people don't want to pay $4 million for a PAC-3 interceptor. They want to look for a shorter answer. Directed energy ends up being another thing right now that a lot of people are looking at, which is high-powered microwaves as well as high-energy lasers. Israel uses something called Iron Beam. We have things like Helios and others. They're going to continue to develop as well.
Colonel, it's good to see you. Catch up and touch base. Colonel Wayne Sanders of Bloomberg Intelligence asked whether we can avoid going back to strikes. It's going to be difficult. Up next on the programme, Sarah Kunst of Cleo Capital, as SpaceX prepares for its first public earnings report. Live from New York City, you're watching Bloomberg TV. Within 2% of all-time highs on the S&P 500 this morning. We're positive by 0.6. Last month, dead flat almost on the S&P. On the Nasdaq, anything but. A bounce this morning, up 0.25%. But last month, the Nasdaq 100 down by more than 6%. And that major move in chips contributing to the weakness we've seen in tech in the last 4 weeks.
Yeah, and the idea that you could have a 21% drawdown, which is the most going back to 2008 in the semiconductor space, while also seeing a near flat market gives you a sense of just how much volatility. The question is, how much is the pain there going to end up being the hyperscalers' gain? Maybe it was just a delayed reaction, but the pendulum seems to be swinging back to some of the big hyperscaler names, the Amazons, the Microsoft, the Google. It seems to be benefiting, at least in profitability, in earnings, and now in stock performance.
That's the stock market. Let's talk about the pain in in the bond market, 2s, 10s and 30s. Let's chop up this yield curve and start at the front end. The front end we're down by 5 or 6 basis points. We were down through the week last week as well, just about. 10-year yields a little bit lower this morning too. 30s pulling back to 522, but 30s last week were up for a 5th consecutive week. I believe that's the longest such streak going back to October 23. So it's been quite a run of weekly advances for a 30-year bond yield. And how many times have we said, Lisa, at times it has felt like that 30-year piece of this yield curve has become untethered. Last week felt no different, and it felt like the Fed had a role to play as well.
We saw a rapid yield curve steepening. That was the wrong kind of steepening. The Fed came out, didn't give guidance. The market said, we don't believe that you have the will to hike rates in the face of inflation. And as Mark Cabana earlier said, ultimately you had a classic inflation and Fed credibility shock. You can argue that it was something else, that it was tied to just the momentum in the underlying economy, potentially tied to Treasury sales in Japan. Nonetheless, this really does go to the existential angst of the moment. Has the Fed lost control of the long end of the yield curve, and is there the willingness to take back control with some serious words, not only from all the Fed speakers this week, but from Fed Chair Kevin Warsh himself?
We could have a big debate about whether they ever had control over the long end of the yield curve, but they're certainly contributing to the volatility we're now witnessing. A reluctance to even talk about with any clarity what the reaction function is, or the preferred tool to address inflation. Is it weighting? Is it the interest rate? Or is it the balance sheet? We don't know. So if you're in the bond market, where can you push right now? The yield curve, much more comfortable pushing around the 30 than 2s when there's an unwillingness to do anything with the interest rate.
You see bank after bank come out and say, we're neutral duration, we're actually underweight, we're going to the front end of the yield curve because we can understand it. The long end, you just don't know. I mean, if they start introducing the balance sheet, you could potentially see yields go that much higher, let alone if this is a Fed that says we're going to target a different kind of inflation target that potentially is already at 2%, so we don't need to do anything. I mean, there are lots of different parameters of this. The data is going to be that much more important.
Spent the weekend trying to come up with ways of targeting the Japanese yen. Dollar yen this morning pulling back. 4 days of yen strength. A 4-day move of 4% on dollar yen in the yen's favour. Dollar yen down to the mid 150s, away from the 160s. We're down this morning by 0.3%. And clear, a very clear and obvious effort to team up with the Japanese and do something about this Japanese yen weakness.
There was a coordinated statement coming out of the Japanese Finance Ministry and Treasury Secretary Scott Bessent in the United States last night, coming out confirming that they had intervened in the first coordinated measure between two countries to intervene in currency since 2011. And they both indicated a willingness to do more. So who is going to bet against that? But for how long will this work unless there is some sort of commensurate action by either the Bank of Japan or potentially the Budgetary Committee in Finance?
Do you remember our currency, your problem? Except this time it's Japan's currency, America's problem. Apparently, based on this willingness, it's never about just friendship. It's always about self-interest too. It's pretty obvious there is some self-interest in all of this.
Couldn't it be friendship?
I wish it was, Bramo. I wish it was.
Between the U.S. and Japan, long-standing allies.
Unfortunately, that's not what finance is about, right?
Can you give me $50 billion, John? Help a friend.
I wish I could, Bramo. I'd like to buy you a dinosaur too.
Thank you. I would like that.
Yeah. But only some people have got the money to do that. Kenny G being one.
Yeah, well, yeah. If he wants to bail me out.
Scotty B being another.
Exactly. They're doing great with memos on their desks.
OK, 2 hours away from the cash open. Let's get you some single names. Some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with the earnings that we've gotten this morning. Marriott shares are falling 3.4%. While the company did raise its full-year outlook, investors did not get the clean beat they were looking for, with the third quarter guidance coming in a bit light. The stock has already run up some 19% year to date, so expectations were elevated. It's become a pattern this earnings season that the higher the expectations, the harder the market has been on any disappointment. And we saw a slight one with Marriott. Moving on to GameStop, it is a big mover to the downside this morning, down 10.5%. After announcing a plan to exchange about $1.4 billion of convertible debt for stock. The move does help to clean up the balance sheet, which of course is a good thing, but investors are focusing on the dilution this introduces. And of course, for a stock that's been long driven by retail investors, that is hardly ever welcome. And we end with some possible deal news. We are seeing AstraZeneca and Bristol Myers moving in opposite directions as we in the FT report that they have held early stage merger talks, and this could be significant if a deal ultimately comes together. together, it would create the world's biggest drug maker by revenue. But as you can see, the market is not convinced, and that is because Astra has one of the industry's strongest pipelines. So investors are questioning why it needs Bristol at all. John?
Yahara, thank you. Thanks for the update. More on that story, of course, throughout this morning on Bloomberg TV. On our radar this morning, President Trump cancelling strikes on Iran and saying new talks are set for today. Tehran still denying it's actively negotiating with the United States. Elsewhere, the US and Japan teaming up to boost the Japanese yen.
We have a good relationship with Japan. We're very strong, very, very strong financially. They wanted a little bit of help, and we're always there for Japan. Japan's been very good to us.
The Japanese currency coming off 4-decade lows following combined efforts in the FX market. The US Treasury Secretary Scott Bessent posting on X, quote, "We will not hesitate to participate in further joint intervention." And finally, Alibaba releasing its biggest AI model yet, Qwen 3.8 Max, the Chinese tech giant, claiming its performance is on par with Anthropic's Fable 5, but at a fraction of the cost. The release boosting Alibaba shares as competition for AI dominance heats up between the US and China.
There are a lot of ways to take this. One could be, what did they do with technology that has been sanctioned from the U.S. into China, whether they used NVIDIA chips that they weren't supposed to, whether they used the training models from OpenAI and Anthropic. I want to take it in another way to this question of open models versus closed models and the debate that is splitting Wall Street right now, splitting Silicon Valley more importantly, where you have some people saying this just shows we need open source in order to compete and flood the zone to compete with China with these cheap models. And then you have the OpenAIs and the Anthropic saying, actually, that's a huge security risk. Look at those models that got out of the box and ate your lunch in a couple of companies that could take on a life of its own. This needs to be controlled. This needs to be regulated. This needs to be closed source. And that is going to be the debate that defines the winners and the losers in the next phase of the AI race.
As you know, Lisa, the debate in Silicon Valley is coloured by self-interest.
Oh, you don't say.
Which debate do you think wins in Washington might be the key question?
I'm not sure, because right now you have the likes of Elon Musk siding with the open source crew. You have the likes of Mark Zuckerberg. You have a whole host of CEOs. And on the other side, you have the CEOs of OpenAI and Anthropic, who both have their issues with this White House. I don't know, and I don't know which is the right answer. I think it is an open debate about the reality of both arguments. Both have credibility.
You mentioned Elon Musk. Let's talk about SpaceX facing its next big test. With its first public earnings report due out tomorrow, the stock is down over 30% since its IPO. Sarah Kunst of Cleo Capital writing, "We know the headline story we'll hear at earnings. What we don't know is how much of a fire sale we'll see and how much Elon and other large shareholders are willing to buy to stop the bleed." Sarah joins us now for more. Sarah, are you suggesting the beginning of the end of the lockup, this staggered lockup that we're about to see, is more important than the earnings report this week?
I think it absolutely is. You know, we, for the most part, don't know who owns those shares. We don't know who's able to participate in this initial lockup tranche. We do know that that sort of 175, I think, barrier they had to hit to unlock even more. I'm pretty sure that that is not going to happen. But, you know, this is going to be a really fascinating test of who actually wants to hold this and what do they think about the long-term sort of promise of the company.
Sarah, how much the move that we've seen since the IPO do you think is about front-running some of those headwinds?
I think a lot of the move post-IPO is because people are getting nervous about, one, the AI trade, the macro in general, and two, they're realizing that this might be kind of the end of the line for Elon's ability to sort of construct reality. We know that we're not on Mars, and I think that when you look at the fundamentals of the company, you kind of scratch your head and say, wait, what am I paying $1 trillion plus for?
Well, this goes to the heart of the issue. How much is Elon Musk losing some of his capital in markets in a big way? You point out, we know the headline story we'll hear at earnings. The rockets are having trouble. The stock is sinking. Starlink works pretty well. AI needs improvement. I mean, at a certain point, are you seeing people look at the balance sheet more than they are listening to the words, the hopes, the dreams of CEOs in an era where people are saying, show me the money?
Certainly in general that is happening, but with Elon, you know, we've been 2 years away from self-driving cars with him, and we always will be, right? So there's a problem when you keep telling people things and they don't come true. And so I think he has a bit of a Chicken Little problem at this point, where people just are starting to not believe, no matter how much they like him, that he will deliver what he says when he says it. And then on top of that, a lot of people don't like the guy. They've heard enough, they've seen enough, and they're kind of sick of it. And so I think that sort of mania that took over Tesla for years of believing that he could do, the impossible has really, really cooled.
Sarah, how much does this set a precedent for the likes of OpenAI and Anthropic, or color the potential IPOs that could be coming out later this year?
I think that we've already seen with OpenAI, it's having a huge impact. Sam talks a lot about how he doesn't want to be a public market CEO. There's a lot of hesitation around that IPO, but at the same time, we know they are absolutely bleeding cash, and that private markets are getting a lot less excited about putting more money in. And I think with Anthropic, there's a question mark there too. They seem like they have better margins, like they will go public, but I think everybody's going to slowly be dropping that trillion and going back to, hey, it's perfectly respectable that IPO is a hundreds of billions valuation.
Is situational awareness a convenient excuse?
I mean, situational awareness is a very interesting peek, I think, into sort of the tech mindset, which is tech is really bad at sort of managing downside risk. We are really good at sort of diamond hands. You put the money in, money printer go burr, number goes up. We are simple investors. And so I think what you're seeing with situational awareness is that there's a lack of it in Silicon Valley. And that is likely to be really tough with things like the SpaceX deal, where the question is, where do you sell? When do you stop backing the founder?
Sarah, that's also the case sometimes on Wall Street as well. And you can see the anticipation building just to buy semis and hardware all over again after the decline of last month. And to Lisa's point, the collapse of that fund, the near blow-up of it, has basically told some people that that's a clearing of the decks, that's a clearing event, and you can buy again. What would you tell investors this morning who are looking to buy into that dip, particularly going into earnings season this week with numbers from SanDisk?
You have to look at the individual underlying company and see, is it a dip for that company, right? If something was 10x overvalued and now it's 5x overvalued, that's still 5x overvalued. And so with a lot of these names, they are so different until you get under the hood. You look at, the PE ratio, you look at the profit margins, if they're profitable at all, and where the growth is going to come from. Because for a lot of these companies, growth is coming from this idea that everyone will need more and more expensive memory forever. And I just don't know if that's true.
Sarah, it's good to see you. Thank you. Sarah Kunst of Cleo Capital. Fantastic to catch up with Sarah. Fantastic also to read her notes, which are some of the best that we get, right?
Mazel tov to the happy couple, Leo.
Right. I hope the wedding went better than the fund expansion.
Can you imagine having that as sort of the lead up to your wedding?
Wasn't he going to have breakout panels at the wedding? Did you see that report?
I did not see that report.
There was going to be breakout panels to have discussions about these big themes. I'm not sure if that was a joke or not, but
it was like breakout panels about whether they agreed with the marriage or not.
No, you have the wedding and then you have like a get together and
that would be fantastic.
You and I are not built like that, but some people are built like that.
I understand.
Where the wedding is an event to climb the social ladder.
Where you need to have a structure to have a conversation.
Have conversations about business, and that's what the table planning's about.
It's like sport.
Is it?
I think that it's sort of, if it's all consuming, it gives you something to talk about.
That's way too much.
Structure to your discussion.
That's way too much. I don't mind if someone's watching the sport under the table at a wedding or something.
Are you kidding me? You think that's acceptable?
No, I think that's fine.
I have knocked that phone out of one of my children's hands during a wedding.
That's more acceptable to me than talking business.
Depends on the sport.
True.
Depends on the team.
And the event, if it's just like an everyday weekly game, that's nothing. But let's say World Cup final, which is bad scheduling anyway, by the way. But let's say it was. If people had a sneak peek, then that's all right.
There are fantastic articles about disrupting weddings. And
this is coming from a man who banned smartphones at his wedding.
I was about to say, I was like, no way would you be accepting
no photos. You're allowed your phones, no photos.
Yeah.
You're allowed your phones.
Yeah, you'd be okay with somebody watching a sports game instead of your wedding.
Be immersed in the moment.
Yeah.
And then watch the game round the back or something.
Are you against it?
Let's get you an update on news elsewhere this morning with your brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Acting Attorney General Todd Blanche is formally ending the Trump administration's proposed $1.8 billion fund for people claiming they were targeted by political prosecutions. The written order could help break a Senate standoff, threatening his confirmation to lead the Justice Department. KKR is buying a 50% stake in a portfolio of assets from Total Energies valued at $2.1 billion. The stake is the latest in a series of green power deals for KKR. Total Energies is pursuing a strategy of offloading stakes in renewable projects to increase returns. Spider-Man Brand New Day winning the weekend box office. The movie bringing in a global box office haul of $927 million, making it the largest opening weekend for any film this year and the second biggest in Hollywood history. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate the update. Up next on the programme, revamping Fed communication.
The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down.
This lack of trust was revealed in the presser the other day.
The problem wasn't the decision itself. Okay, it was the absence of a strategy to achieve the mission.
Neil Dutta of Renmac joins us next, live from New York City. You're watching Bloomberg Surveillance. Stocks this morning up by 0.6% on the S&P, on the Nasdaq up by 0.16. Just confirming there were breakout sessions
before a pre-wedding colloquium to discuss big ideas.
So like the welcome event was a breakout session.
Correct. Maybe on love.
I doubt it.
The meeting of marriage.
I mean, it might have been.
I think that would have been great.
I'm not sure if that was the intention or not. Let's turn to the bond market. 2s, 10s and 30s. Yields declined this morning across the curve. 10s down to sub 470, sub 430 on 2s. Comfortably below that level just for now. Things can change quickly, of course, in this bond market. We're down 5 to 424. Under surveillance this morning, revamping Fed communication.
The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down.
The market doesn't know the new rules.
It's clear he's not going to say a lot.
This lack of trust was revealed in the presser the other day.
Unfortunately, I thought it was a little bit rocky.
The problem wasn't the decision itself. Okay, it was the absence of a strategy to achieve the mission.
So here's the latest this morning. Fed Chair Kevin Warsh weighing reducing the frequency of the central bank's policy meetings. Sources telling us here at Bloomberg that Warsh is discussing the idea of meeting 6 times a year to decide on interest rates. We've got a busy slate of Fed speak ahead following last week's interest rate decision. Neil Dutta of Renmac anticipating that, writing, dissents will only mount with the chair increasingly isolated from the rest of the committee. Eventually, they'll need to move the policy rate this year. Neil joins us now for more. Neil, welcome. Good to see you, buddy. We've been talking about this Wall Street Journal piece that Bramo flagged earlier on this morning. I'm sure you had a look. Lead paragraph. Quit whining about the Federal Reserve. Your clients are paying you a lot to make judgments about risk and returns in real time. It's embarrassing when you complain now that Daddy Fed isn't telling you how to do it. Neil, does that get to the issue or miss the point?
No, that misses the point. Look, it's not about being spoon-fed the next meeting or two. That's not what this is about. This is about trying to first, frankly, have a chair that makes sense when he talks. I mean, this notion that, oh, the market's doing the work for me, therefore I don't have to do anything. So I suppose he should have cut interest rates last month, and then the market would have done all the work for him. It's like, a page out of the Erdogan School of Central Banking and Raising Rates for people that want to learn to do other things well, too. I mean, to borrow from Derek Zoolander. So I think it's a bit ridiculous. I mean, obviously, it's coming from the op-ed pages of the Wall Street Journal. I mean, what do you expect? These are sycophants for Kevin Warsh. But, this is about trying to lay out a strategy for how you achieve the goal of price stability. That's really what this is about. Look, I mean, don't take my word for it. Look at what the bond market did, right? I mean, longer term interest rates up, broad dollar exchange rate down, term premia higher, inflation expectations up. So this notion that, if the market did the tightening for it, why did inflation expectations go up and the dollar go down? So, yeah. It's a bit ridiculous.
Neil, I love Mark Cabana of Bank of America. It's another T-shirt or mug coming. You can't fool the bond. And that's sort of what you're leaning into. Take a look at what long-term bonds did. Do you think that the reaction that we've seen in markets makes it more likely that the Fed has to hike rates to get their credibility back and potentially to wrangle in some control of the long end?
Well, it didn't have to be about credibility, Lisa, but I think now it's become more about credibility. I mean, does anyone really believe that someone like Waller or Williams or Powell or any of these people were enthusiastic about what they saw at the press conference in July? I mean, I think they're probably quietly embarrassed by it. So at the margin, I think it's going to embolden the rest of the committee. And as I said, I mean, I think the chair will look increasingly isolated from the rest of the committee. And He had an opportunity to kind of exert some control over the committee by hiking last week. I thought, he probably could have sold him on it. He chose not to. And, as a result, I think he's going to be forced into it in September.
Well, Neil, Jim Bianco had a great phrase over the weekend saying to censor the new forward guidance to the point that you're making, which gives a real question, and you're illuminating it right now, this idea that he's losing control and that Kevin Warsh is ceding control over the Federal Reserve to the other members. How important was it that there were no governor dissents in this meeting, and how much do you think that is going to change?
No, I think it's going to change. I mean, even if you think about someone like New York Fed President John Williams, right? I mean, he supported staying on hold, but if you look at his own views, I mean, he's basically telling you that he needs to see core inflation running, at or below 0.2%, give or take, month in and month out between now and, let's say the next few months. I mean, the likelihood of that happening based on the last few years of data is very low. I mean, there may be good reasons to expect inflation to cool down, but the question is whether it cools down in such a way that it satisfies the word soon. And I don't think that that's likely. So to me, expecting some of these people to vote for a rate hike, I think we're getting, much closer to that point than not. And, I think also for someone like Governor Waller, frankly, he was more or less right there. Going into the meeting. And as I say, I mean, it's really a bet on like one sloppy inflation report. And I think if you had to ask me, like, what are the odds of that happening? I would say pretty high.
Neil, it's good to see you. Neil Dutta there of Renmac. I think that last point's really important. The backdrop for the bond market right now is pretty unforgiving, and we've seen that in the last week. Unforgiving of mistakes, whether the chairman believes he made one at that news conference or not, is going to be part of the debate until the next news conference. Also, the economic backdrop. I think the conversation we'd have around the table is if it's quite forgiving, a resilient economy that will stand up to some of these higher rates, and certainly has done so far. Neil was making the point that you might have just seen a peak in growth, but maybe not a peak in inflation. And that inflation story is going to stick around and be problematic for the year ahead. And that's stagflation light, in his words. And that's not a forgiving backdrop for the economy either.
The nature of these supply shocks is that they are not one-offs. We have seen that repeatedly, whether it was the pandemic, whether it's the oil shock, whether it's some of the others. What do you do when you have sequential supply shocks that still are coming down the pike potentially? It creates a difficult environment for a Federal Reserve.
Up next on the programme, we'll catch up with the IBM Vice Chair, Gary Cohn, Don Rizzo of T. Rowe Price, Nancy Lazar of Piper Sandler, Mike Contopoulos of Janus Henderson. The third hour of Bloomberg Surveillance just around the corner.
All in all, earnings were pretty good across the board.
The beats are being rewarded.
The equity market overall is doing fine.
There's still lots of demand for equities.
The right trade is not to trade. Hold your core positions.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action of scores looks like this. Building on 2 days of gains on the S&P, higher again by 0.5% on the S&P 500. On the NASDAQ, pretty much unchanged following a rocky month of July for the NASDAQ and chip stocks, down by more than 20% for the semis through the month of July. Into the bond market, 2s, 10s and 30s. Yields declining across the curve this morning. 2s down by 6 to 423. 10s down by 6, also 30s lower as well. 30s a point of tension in the last week. 5 consecutive weeks of high yield to the very long end of the curve this morning, 522. In the commodity market, crude and Brent declining. Talks, strikes. Back to talks again. Brent down by 5 or 6%, 83 on Brent. WTI around 79. And dollar yen, 4-day move, 4 percentage point decline in the yen's favor. Dollar yen this morning of 156.
I can't keep up with the different once-in-a-lifetime types of moves that we're seeing right now, whether it's the abandonment of forward guidance and what that does to the market, or whether it's what's going on with Japan and the first bilateral currency intervention between the U.S. and another nation going back to 2011, with the U.S. Treasury Secretary Scott Bessent intervening and joining the fight with the Ministry of Finance in Japan to sell down euros, to buy yen in order to stave off some of the declines that we have seen in that currency. All of these things coming together to try to paint paint the scene. Is this a new world or the old world where markets used to have some sort of volatility and market making and decision making, or is this something that is profoundly new and potentially crimping growth?
Have we found the author of the journal op-ed?
I think we may have.
Over the weekend, possibly. He's going to deny. Coming up, IBM Vice Chair Gary Cohn, with stocks kicking off the week on a firmer footing. Don Rizzo, T. Rowe Price, saying we're past the worst of the unwind in tech. And Nancy Lazar of Piper Sandler saying hyperscalers are slowing hiring to a crawl. We begin this hour with stocks rising and crude falling ahead of a busy first week of August trading. Joining us now, the former NEC Director and IBM Vice Chair Gary Cohn. Gary, good morning. Good to see you.
Good to see you. Thanks for having me.
You've been following the debate. I want your reaction. You know Kevin Warsh well. What is everyone getting wrong? And I say everyone, I mean the consensus view on their reaction to that news conference last Wednesday.
I'm not going to characterize this as anyone's getting anything wrong or anyone's getting it right. What I'm going to characterize this as, Kevin is a masterful student of the market. Kevin has been at the Fed before. He understands the limited toolbox, but the effective toolbox that the Fed has. What Kevin is doing right now, and I think people don't like this, is Kevin is reverting the Fed to the historic norms of what the Fed did. We, unfortunately, as newscasters or as market makers or as traders, we got spoiled from the 08 period on. From 08 period on, the Fed has been an open box. They've been completely transparent. They have not done anything that you wouldn't know they would do hours or weeks or months before they did it. And the market became addicted to knowing what the Fed was going to do. What Kevin is doing right now is he's trying to get the market off the addiction of me, the Fed chairman and the Fed board, having to tell you what we're going to do. And you, the market, and you participants, you should go and participate however you think it makes sense for you and wherever you think the opportunities are. This is a tough transition. People liked having the answers to the quiz before they took the test.
So there's a markets question. I also think there's an economics question that needs to be addressed. The issue for us, I think, is less about the lack of guidance, less about having the answers before the test, more about you've got an inflation problem, why you're not doing anything about it, which essentially was the Mike McKee question in the news conference. Why are you waiting? What are you waiting for? Without giving us any real clarity on the preferred tool, why they're waiting, whether they carry on waiting, and at the same time telling us to believe them that they'll do something about inflation. I think the economic question is the difficult one to answer.
Look, Chairman Warsh has gone out of his way. I mean, he's literally gone out of his way to tell you he is an inflation fighter, that the stable price mandate and the 2% inflation guide is his bellwether, and he's going there. He has limited tools to get there, as we know. In fact, he has said in the speech, I have two tools to help us get there. I can raise rates or I can sell down the balance sheet. Those are his two tools. Raising rates, as we know, will affect the overnight rate, the Fed fund, that has very little effect on the economy as a whole. The real effect on the economy is, let's call it in the 5 to 10 year bucket. That's where most people borrow. That's where consumers borrow. That's where credit cards are. That's where student loans are. That's where automobile loans are. That's where mortgages are. Kevin knows that. What he's also telling you is right now, the market is doing its own work in steepening the yield curve. So in less than a year, we have gone from a 2s-10s interest rate curve, inverted about 20 basis points, to positive 40 basis points. We've moved 60 basis points in 2s-10s rates. So Kevin is saying, look, the market is doing my job. They're making the ability to borrow money out on the curve more and more expensive. And it's going to continue to get more expensive. If I raise Fed funds, yes, I can raise Fed funds. I'm not sure that has the effect. I think what he would probably prefer to do is he'd prefer to sell down the balance sheet, which again would put more supply into the market, which would steepen the yield curve. But the market's doing that for him right now. So being in that chair for less than 2 months, or about 2 months, but he happened to come in a funny time where a week and a half after he came in, he had his first meeting. Then 30 days later, he had his second meeting. He then told you nothing happened in those 30 days. He's sitting here, and I think he's evaluating where he wants to be. He's lucky on the schedule. He doesn't have an August meeting. He does have Jackson Hole. He could tell us what's going on in Jackson Hole. So I think Kevin wanted to probably get through those first 2 meetings, make it clear to the market that he is an inflation fighter, make it clear to everyone who's watching that the market is doing much of what he would have tried to get accomplished early. And he's going to have the month of August, before the September meeting, to come out and deliver a relatively baked plan in his mind. He's not going to give you the baked plan, but he himself will have a highly baked plan.
Do you think that the sell-off in the long end of the yield curve is by design? That what he saw after the Fed meeting with 30-year rates going to the highest level since 2007 was a good thing?
It's doing Kevin's jobs for him. At the end of the day, if you want to slow down the economy and you want to tamp inflation, you have to make the cost of money more expensive. So if the 30-year rates went up, which they did, and the 10-year rates went up, and the front end of the curve basically stayed the same, which means we had a curve steepener, you are accomplishing what a Fed chair would want to accomplish if you're trying to tamp down inflation and moderate. I don't think it's just Kevin that's doing that. I think Kevin's being very realistic to what the environment is today. He knows that Treasury borrowings are going up every year. He also knows there's this enormous amount of need for debt in the AI compute data center world, where we're talking about potentially another $1 trillion of issuance going on in the market today. The market is finding a home to clear these bonds. It's also raising longer term rates. It's putting more risk premium into the curve. All things that Kevin is probably happy are happening without him having to do anything.
Scott Bessent did something over the weekend, and I wonder how related you see this as, the idea that there was a coordinated intervention in the yen. Some people are speculating it's because the Japanese finance ministry was selling treasuries to finance their unilateral intervention in their currency. And this could potentially help support U.S. yields from going much higher. Do you believe there is any coordination between the two?
Well, we know that the U.S. and Japan coordinate.
No, I mean coordination
no one's
between
denying. No one's
the move
denying
in
that.
the 30-year yields in the U.S. and potentially what happened.
Look,
in the US
I
and Japan.
think there are multiple factors in why the U.S. would have got involved in intervention. Obviously, the yen trades at would force people into transactions where they may be selling U.S. securities to buy at home. It also has to do with trade balances. Remember, we've got an administration that is fixated on trade deficits. So to the extent that, foreign products come into the United States below what we think is a market clearing price, or our products are extraordinarily expensive to someone that we would like to sell to, there's a way to try and equal out the trade deficit or trade balance with the country as well. So I don't think it's a single factor model. I think when Scott Bessent gets the phone call from the Bank of Japan, he's evaluating all of these factors. He's evaluating what's going on in supply demand of treasuries from foreigners, what's going on in the trade market, what's going on with the trade deficit specifically with Japan. And each one of those has a different input into the equation to go ahead and move forward.
Knowing Bessent, he might have been the one that made the call. Sort of laser focused on these issues.
Well, he has had experience with that with the Bank of England, so why not bring it over to Japan?
How fragile is the backdrop for markets right now? All these little things going on, tension in Japan, situational awareness, that fund getting into a bit of trouble in the last week too. How fragile do you think the backdrop is?
I don't know if the market, if I'd call it fragile. I would say we have as much instability or balls up in the air as we've had. I mean, usually there's one or two driving factors in the market. Today, we've got a myriad of factors. We've got the war going on. We've got the price of oil going on. We've got the major CapEx AI investment going on. And the question is, you've taken some of the largest companies in America that historically have owned intellectual property and were massive free cash flow generators, and then they recirculated that cash into the market, either by buying assets, buying other things, returning it in dividends, buying back shares. You've taken those companies and you've now made them huge asset gatherers, huge asset builders, and they're no longer creating free cash flow. In fact, it's the first time I can remember in the history of an earnings call of some of these largest companies when they're talking about, we will stay positive on free cash flow. It's hard to understand that. These are companies that were producing, tens of billions of dollars a quarter in free cash flow. So the market's digesting that. We went through the software scare versus the AI scare. Market's digesting that. We're trying to figure out where all these pieces come together. So there's an enormous amount of instability in the market. At the same time, rates are going up, but the consumer, we know the consumer continues to spend. So even when you look at the GDP numbers, the strongest pieces in there are the consumer spending. Now, we can even go further. We know the consumer is spending, but we also know that's a bit of a bifurcated event. We know that the wealthier consumers in this country are consuming at extraordinary high levels. And we know the low-end consumer is barely getting by. And this is one of the dilemmas that everyone's trying to deal with. And how does this filter through markets? I think all of these pieces of instability are out there. And look, markets can handle one or two pieces of instability. They start to fail when it's 3, 4, and 5, and they really fail when it's 3, 4, and 5, and they're totally out of their control. Or the answer is 6 to 12 to 18 months off.
That's what I'm trying to work out. How close are we? So you've got a massive competition for capital. You articulated that really well. Yeah. You've had a huge terms of trade shock out of the energy market that's hitting Japan when they've already got a fragile backdrop. On top of that, there's evidence of leverage building up in places like South Korea and hedge funds blowing up. And I wanted to go back to the very beginning of this conversation, whether now is a good time to go back to the old world of reducing forward guidance and the hand-holding post-GFC at central banks. How difficult will that mission be?
I don't think it's difficult. Like I said, we've been trained since 2008 to today to expect the Fed to telegraph and forward guide. Prior to 2008, when I was trading for a living and running big trading desks, we did not know when the Fed was going to move. There were surprise meetings after surprise meetings after surprise meetings. You know, the Fed doesn't have to wait for a scheduled meeting to cut or raise interest rates. Now, they have not done it really since I guess they did it in COVID. The last time they did it was 2020. We had a 100 basis point cut on a Sunday evening in COVID, if you remember. But we've now gotten to this point where the market insists not only there be a meeting with a press conference. You can't have actions unless there's a meeting with a press conference. I think the chair is trying to say, no, I have a job to do. We will meet whenever necessary to raise or lower rates. We will meet whenever necessary to do any action we need to do based on what's going on in the environment, not based on the schedule that I put out 18 months in advance.
That's bringing the discipline back to capitalism and financial markets. I'm not averse to that at all. Just trying to work out the consequences of making the switch when you've been feasting on easy money and forward guidance for 15, 16 years and knowing they're always going to be there to have your back and step in whenever there's a problem. And they'll offer you the guidance. And the way you put it, they'll give you the answers to the quiz before you sit the test. Wall Street's feasted on that for years.
They have.
That's why I use the word fragile. How much fragility is in the system that needs to be unwound as we make that transition back to the old world?
I don't think there's as much fragility as you think. Like I said, most of my career trading, I had the opposite world.
Because you had the two-way discipline. You had the discipline.
I had to be disciplined. I had to assume when I went home with a position or I made a price for something, and I ran a big mortgage business for a while, ran a big treasury business for a while, ran a big equities business. I had to assume that the Fed could meet any moment and change policy. And were we trading appropriately? Were we managing risk appropriately? Instead of saying, oh, I don't have to worry about that there's a Fed put, or rates can't change until September something now because there's no Fed meeting. Maybe they'll say something in Jackson Hole, so I'll manage my risk up till the Jackson Hole meeting. I'll wait for that, then I'll manage my risk differently after that. That's not the way markets should work. The markets should manage themselves in a way that anything is possible on any given day.
I hope we go back to that world. I just know that when Lagarde tried that, we're not here to close spreads. Lagarde quickly closed spreads straight afterwards. Right? It's difficult to make the transition.
The question, and I think you're alluding to it, John, how much has the financial market changed and debt built up under the old regime that has to be unwound in a period of a new regime that potentially is much less transparent but allows markets to do their thing?
Did you write the piece, Gary?
I did not write the piece.
OK, just to clear that up.
That said, you know, there are an enormous amount of hedging tools today. So as you see debt move up and you see the private credit markets explode, which has been very helpful, you know, you can hedge your interest rate exposure. You can't hedge your credit exposure as much, but hedging underlying interest rate exposure happens to be one of the most developed markets in the world. You can hedge interest rate exposure in almost virtually every currency that we issue bonds in today. So managing interest rate exposure is not hard. Now, people have historically said, well, I know exactly what the Fed's going to do. I don't need to manage this. That's probably not a good outcome. It's probably a better outcome when people look at their risk and say, my interest rate risk is X. Am I happy with that or not? Not, oh, I don't really care because the Fed's got my back.
Gary, could talk to you all day. Appreciate it.
Always
Thank
a pleasure.
you, sir. Thank you very much. Gary Cohn there, the IBM Vice Chair. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says new talks with Iran will begin this afternoon. Trump called off planned attacks on Tehran following appeals from Saudi Arabia and other U.S. allies in the region. He also suggested a deal on reopening the Strait of Hormuz may be close. Tehran denies it's negotiating with the U.S. Federal Reserve Chair Kevin Warsh is considering changing the Fed's meeting schedule. Sources telling us here at Bloomberg, Warsh is thinking about cutting annual policy decisions to 6 from 8 meetings, while reserving 2 gatherings for in-depth discussions of economic issues. AstraZeneca is exploring an acquisition of Bristol-Myers Squibb, a mega deal. Sources telling us here at Bloomberg, discussions are at an early stage. If completed, it would create one of the world's largest drug makers. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus, Dominic Rizzo of T. Rowe Price with more key tech earnings just around the corner. Live from New York City this morning. Good morning.
Tech is really bad at sort of managing downside risk. You put the money in, money printer go burn, number goes up. For a lot of these companies, growth is coming from this idea that everyone will need more and more expensive memory forever. And I just don't know if that's true.
Sarah Kunst has her doubts over at Cleo Capital. Sarah Kunst there weighing in on tech a little bit earlier on. Let's get you some price action and some morning calls. Equity futures this morning up by 0.5% on the S&P. Our first call from Goldman, adding Applied Materials to its US conviction list, saying it's well positioned to gain market share. Your second call from UBS, downgrading NXP Semiconductors, noting a less compelling growth profile. And finally, Stifel cutting its price target on Tesla, citing a lower valuation based on a sum of its past analysis. That stock is up by 0.2%. More insight into the tech trade this week. We'll get earnings from AMD, SanDisk, and SpaceX. Dominic Rizzo of T. Rowe Price maintaining a bullish outlook, writing, I feel we're past the worst of the momentum unwind. I remain very constructive on AI infrastructure and semiconductors. Dom joins us now for more. Dom, welcome to the program. Where exactly does SpaceX fit in to your outlook?
Well, first off, thanks for having me, guys. It's great to be back here. Look, when I think about SpaceX has the potential to be a Pareto-efficient frontier model. But right now, when you think about where the economics are accruing, all the economics are truly accruing to the frontier labs, OpenAI and Anthropic. You know, when I did the Anthropic round last summer in the global technology strategy, they were just doing $5 billion at ARR. You know, now the rumor is well north of 70 billion. So let's see if they can put together the assets they have, which is an amazing GPU cluster, this cursor asset, and a very strong model to reach that frontier. But right now, I think the vast majority of the economics are accruing to OpenAI and Anthropic.
Dom, with that in mind, do you think SpaceX pivots more to the rental kind of deals that we saw with Google, with Anthropic? Do you expect to see more of those kind of things?
It's possible. I think that was a short-term dynamic rather than a long-term dynamic. I mean, the thing that was so striking about those deals was that their price was, $40 billion a gigawatt, which is, 2 to 3x the spot market, right? And I think that tells you a few things. But one, I think it tells you what's the ROIC in this business for the application business companies or the hyperscale infrastructure companies. I think is very strong over time. And then two, I think that they believe in the long-term model, but they wanted to make sure that they sign short-term deals where they can pull back that capacity if they needed to.
You mentioned something, Dom. You still think that OpenAI and Anthropic are going to be the beneficiaries, perhaps, of some of the areas where SpaceX wants to get involved. I wonder if some of the developments over in China and sort of the preeminence of the open source models is undermining some of the prospects for the likes of OpenAI and Anthropic, and if we're seeing the financial benefit increasingly consolidated to the hyperscalers and to perhaps a lesser extent in the future in semiconductors. How do you take that narrative? Where do you take that?
Absolutely. Well, first of all, I think you raise a really good point. Open source is wonderful for the chip stocks, right? NVIDIA in many ways is the absolute king of open source. These models are extremely large, right? The Kimi K3 model out of Moonshot, 2.7 trillion parameters. They recommend that you use 64 different accelerators to run it. So I think open source is an unequivocal good for the chip companies. Now, the question is, what does open source do for frontier economics? And what we've actually seen is the cost curve at the leading edge, right? Like if you look at the difference of cost per million tokens of, say, Kimi K3 versus GPT Sol, it's actually increasing, right? And if you look at cost per task per completion, it's very strong for ChatGPT. But I think there's so many things that go into it rather than just cost economics of the tokens, right? It's applications, it's distribution, it's actually performance, right? What's the difference between an average lawyer and the best lawyer in the world, 20, 30, 40x? I think that's true for the frontier models as well. It's very hard to price incremental intelligence, but I think incremental intelligence is extremely high. The other thing you mentioned is ROIC for the hyperscalers. I do think the hyperscalers have a place of delivering these open source models to enterprises all around the world. And I think what we've seen this earnings season is a resounding endorsement of high ROIC on this investment, right? Satya Nadella tweeting and the Morgan Stanley piece citing 30% ROICs. Jassy talking about on their call that for the shortest life cycle stuff, the data center chips and the network and the servicing, that they get payback in 2 to 3 years and that the useful life is 5 to 6 years. And then finally, we've seen accelerating growth out of all the hyperscalers. AWS, 37%, Microsoft Azure, 43%, Google Cloud, 82%. I think these guys are going to keep spending, and I actually think we may actually see accelerating CapEx growth next year.
So, Dom, can I ask you for a pick, a single name, something you like after the beaten up names we saw last month were dominated in the chip sector? What do you like now?
My biggest bet for a long time has been AMD. And why do I like AMD? Number one is CPU inferencing, right? So Intel's talked about this, that if we go from a training world, the ratio of GPUs to CPUs is 8 to 1. In an inference world, it's maybe 1 to 1. It may actually be 2 to 1 in favor of CPUs. At their AI Intelligence Day just the other week, AMD took their CPU TAM up from $120 billion just a few months ago to $220 billion. And then finally, I think their accelerator, the MI355, is very strong.
Dom, appreciate it. Dom Rizzo there of T. Rowe Price. That stock down last month by 18%, in line with the decline we saw across chips. Up next, Nancy Lazar of Piper Sandler. One hour out from the opening bell. Stocks this morning doing okay, up by 0.5 on the S&P, on the Nasdaq up by 0.2. Great conversation with Gary Cohn a little bit earlier this hour on getting back to the old world, pre-GFC. Very little central bank guidance, very little central bank dependence in this market. Can we return to that world, or is this market just very different?
Yeah, how dependent is this market on interest rates having a certain degree of stability? And Gary Cohn was saying, well, they can hedge that interest rate exposure with interest rate swaps and other manners. There's an entire market to do so. And so ultimately, it just will cause market participants to be more careful. That said, the market has changed a lot since the financial crisis.
Massively.
With the amount of debt that's been incurred, with the amount of corporate and government debt, not only the trading strategies that have emerged and the technology, you put all this together and you asked a great question. Are we in a world that has fragilities emerging that will fundamentally have that much more fragility baked in during this period of pretty dramatic transformation?
Will that transition come with consequences, and what would those consequences be? So what's changed? We can talk about it. You mentioned a few dynamics. Debt to GDP ratios are much higher now, as sovereigns, much, much higher. Deficits are so much bigger than they were. The wealth channel has become increasingly important, particularly in an economy like the US economy, becoming more dependent on what happens with financial markets and the value of stock markets. Are you willing to make that transition back to the old world if the consequences are that some of the things that we've become dependent on start to be upset? Equity markets start to correct. You're going to tolerate that. If you start to see yields rise at the long end, the Treasury starts to knock the door and complain. Are you going to tolerate that? They're all things that are going to be really difficult to do. Can you take the balance sheet back to anywhere near the kind of size that it was pre-JFC? You're going to tolerate the consequences of that? They're big questions.
Yeah, are you potentially going to slow the economy much more than you otherwise would with allowing the long end to do its own thing and to go higher in response to what they're doing or not doing at the front end? I will say how the AI build-out interferes with this as well, because if you want to support the infrastructure build-out of some of these companies, do you also need a certain degree of stability, or is it completely independent of the interest rate policy, even at yields north of 5% in the long end?
I understand the nostalgia and the romance to want to go back to that world. I'd like to go back towards that world as well. Two-way risk, market discipline, real capitalism. Because the complaints that you hear about capitalism today, you're not complaining about capitalism, you're complaining about something very different. Capitalism has been absolutely butchered after GFC. You're complaining about something different. Making that transition will be difficult.
It reminds me of people who say we once had mortgage rates of 15%,
right,
and we still bought houses, and it was fine. And in fact, it was easier to buy houses.
Bought houses for a bag of beans.
You bought houses for $25,000, so it wasn't the same kind of thing. Now house prices are elevated because of where interest rates and mortgage rates have been. How do you right-size that?
With difficulty, and let's see if it is the ultimate objective and an objective they'll stick with. Equity futures right now in the S&P, as I say, positive by 0.5 on the S&P, on the Nasdaq doing okay as well, up a few tenths of 1%, with some market movers, some morning movers, some single names ahead of the open. Yahira has more. Hey, Yahira.
Hi, John. The historic U.S. cattle shortage continues to be a problem for Tyson Foods. Shares are falling 3% after the company cut its full-year profit outlook as high cattle costs continue to squeeze its beef business, which of course is its biggest business. We have seen signs that the industry could improve with imports from Mexico set to resume soon, but we are still months away from seeing any of that actually filtering through to meat packers like Tyson. Meanwhile, we are seeing AMC shares rallying up nearly 6% in the pre-market after the theater chain posted the biggest weekend in its history. More than 10 million moviegoers turned out, fueled by the opening of the new Spider-Man movie, which delivered the second biggest opening weekend ever. If you're curious, the first was Avengers Endgame back in 2019. And back then, a bucket of popcorn was much cheaper than it is now. But even now, moviegoers are still spending while they're going, since AMC also set all-time records in concession revenue. And we end on the memory chip stocks. They are picking up right where July left off, in the red after a roller coaster month for this sector. Some of it may be the Alibaba news with its unveiling its biggest model yet, and underscoring this idea that you could do just as much with much less. John?
Yahara, thank you. Thanks for this morning. Given how much Spider-Man grossed at the movies, it's amazing how little I saw of it. I had no idea it was even out. Maybe that says something about my algo right now, that I just saw tons of complaints about the Odyssey.
Yeah.
Right? But very little about Spider-Man being out at theatres near you.
It shows how people are truly in segregated areas. Although I actually am interested in this movie. I like the Into the Spider-Verse movie, and evidently we took a look at tickets and they're all sold out. It's similar.
Oh, you're trying to go?
Well, I wasn't. Okay. I was trying to get it for my kid.
You watched the Odyssey yet?
I haven't, but I'm going to watch it this week.
Okay, all right. Let me know.
I've heard mixed things, but
I've seen the complaints, and then I've heard people say they enjoyed it.
I love the story, though. I loved it, so I'm very excited.
You should have a look at the podcast with the Chinese interviewer and Nolan. I saw a few clips of that over the weekend, and they get really deep into philosophy and stuff like that.
Love
it's
that.
An interesting exchange. You might enjoy that.
Thank you.
Might enjoy that. All right. Busy week ahead for the US economy, culminating with payrolls on Friday. Michael McKee joins us now for more. Good morning, Mike.
Good morning, John. I'm going to put the Fed forward first for the week because everybody wants to know what they're going to do after we didn't get a whole lot of hints from the new chairman, Kevin Warsh, last week. You had a great interview with Mark Cabana this morning on this subject, and I think a lot of people are going to be following his lead and saying the bond market is not going to be happy unless they get more information. The problem is most of the Fed speakers this week are non-voters, and some of them we already know their opinions. Williams out this morning on the tape, as people in the markets like to say. Tomorrow we get Jeff Schmidt, who's in favor of raising rates, but he's not a voter. We do get Lisa Cook on Wednesday. She's a voter. Mary Daly Musalem was out Friday already, barking, not a voter either. Bowman on Saturday, but you can't trade then. So we'll keep an eye on what these people have to say, but it may not add to the stock of information. Since we last talked on Friday, though, we've gotten a lot more information. Williams this morning, as I mentioned in an interview with Reuters, saying that inflation is going to be falling in the second half and it'll hit 2% in 2028, something he has said before. Alberto Musalem telling us on Friday he would support a rate increase. And then the story of the weekend, Kevin Warsh is suggesting 6 meetings a year instead of 8, and only 4 of those would be around changing monetary policy. So the August 19th Fed minutes could be very, very interesting. And I finally throw in there Scott Bessent saying that the Fed should increase its foreign and international monetary authorities repo facilities. So the Fed could provide more liquidity in dollars to the markets without having to take currency risk. As far as the economic data, it is all kind of one-sided to the inflation side of the Fed mandate because we get a lot of jobs numbers and the Fed's not particularly worried about jobs. We get ISM manufacturing later today. We'll look at the prices numbers on that. JOLTS on Tuesday, ADP and ISM services on Wednesday both have employment issues with them, employment data, claims on Thursday, and July jobs on Friday. That's always considered a big one, but if we don't get much of a change and we see the unemployment rate unchanged, then people are immediately going to shift their focus to the CPI, PPI, and other inflation reports that we get coming up this month.
Mike McKee, thank you, buddy. As always, looking ahead to payrolls and a whole lot more. 80K, the estimate in our survey for this coming Friday. Nancy Lazar of Piper Sandler taking note of slowing trends in the labour market, writing the tech capex productivity link is playing out in real time in big tech, with many such companies slowing hiring to accrual. Nancy joins us now for more. Nancy, that's one sector that has a big role to play in this economy, for sure, without a doubt. For the broader economy, for the labour market right now, Nancy, are we on course for a decent 80 this Friday, or do you see some vulnerabilities building?
No, I think we are on track for continued increases in the labor market in payroll employment. Unemployment claims, are the clearest signal. So even though some of the large tech companies aren't hiring, maybe even firing, on balance claims are down over 8% on a year-over-year basis. That means the labor market is actually accelerating. And so I think obviously these monthly payroll numbers can be very, very volatile. And as Fed Chair Warsh has suggested, payroll numbers are good after the third time they're reported. So we're seeing gradual improvement in payroll. Why? Company corporate revenues are up double digit. They're up 10, 12% on a year-over-year basis. And so companies have the wherewithal to hiring, and they are. And tech companies are hiring in the good side of the economy, the trade side of the economy. There was an article last week highlighting how you are seeing lots of trade type jobs being put in place because of the build out of the data centers. Meta is putting in place a free trade program to train people to build things, and so there is indeed jobs being created because of tech. It's not all one-sided, but bottom line is broadly yes, the labor market is clearly in an improving trend, reflecting the strength we have in corporate profits and corporate revenues.
What's more important for you to get a forward look on the economy, Nancy, over the next 6 months? What we see out of the labor market with non-farm payrolls and potentially even JOLTS, or what we hear out of the Fed officials who are going to be speaking this week following the Fed meeting on Wednesday?
The most thing that's going to be most important over the next 3 to 6 months is the continued health of corporate America. The Fed is we would argue somewhat behind the curve. By that I mean they're supportive of growth. The Fed is still stimulative for growth. It's a reason why employment is going to continue to increase, because Fed funds are 3.6% on average. Nominal GDP growth is 6.5%. The cost of capital is low, and that's going to be a major force keeping the labor market moving ahead.
At what point will the 10-year and 30-year yield, going significantly higher to some of the highest rates that we've seen since 2007, potentially constrain some of the corporate strength that we're seeing?
We really don't see that for at least another year. We use a 2-year change in the 10-year yield, and it's up about 50 basis points on that metric. It's still historically not up a lot. It's not the level that drives economic activity. Think of it's the interest rate momentum. It's the change in interest rates that drive economic momentum. And as of now, I ran a simple ISM model over the weekend, and it's the 2-year change that drives the ISM. And based on that model, it's likely to continue to be over 50 through 2027. So not really until 2028, and that's ridiculous. I can't forecast that far out. But the bond yield is not yet restrictive to the economy because there is so much liquidity, money growth, bank loan growth, government spending is picking up. That's all reflected in this healthy nominal GDP, strong corporate revenue. So we don't see bond yields as a headwind to the economy for the next 12 to 18 months.
And Nancy, it's pretty obvious at this point that the Fed is changing style. Communication is different. Yeah. We had a conversation earlier in the hour with Gary Cohn about transitioning back to the pre-GFC world. Less guidance, less hand-holding. How smooth do you think that effort will turn out to be?
It's probably going to be bumpy. But historically, Fed tightening cycles or changes in Fed policies are always bumpy. I've done this chart for probably 30 years, every increase in interest rates, every change in Fed policy also always creates financial strains. We saw it in the 60s, in the 70s, in the 80s under Volcker, again in the 90s under Greenspan. We've had several changes in the regime of the Fed. I remember when we switched to targeting money supply in the late 70s, early 1980s. That was a very volatile time, but at the end of the day, the goal was always to lower inflation. And that is what is really key to not necessarily the high-income consumer, but the lower to middle-income consumer. And so the trade-off of ingrained inflation for a sustained period of time because of a Fed that's potentially behind the curve is actually the worst-case scenario for that lower to middle-income consumer. So I'm excited about the path that we're going down, focusing on a change in Fed policy. Lisa, as you said earlier, one of the reasons we have high house prices is because the Fed held rates too low for too long. We've had 3 housing bubbles over the past 30 years because of exactly that. The Fed kept rates too low for too long. And so time will cure the high price levels. Time will help cure the high house price levels through engineering a healthy job market, allowing affordability to improve because incomes improve.
That's the goal, Nancy. We all hope you're right. Nancy Lazar there of Piper Sandler on the US economy. Let's give you an update on news worldwide with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Hey, John. Thank you. The Senate announcing a bipartisan deal aimed at avoiding a government shutdown this fall. Senate Majority Leader John Thune plans to bring the measure up for a vote this week ahead of the chamber's scheduled August recess. Hackers are draining Bitcoin from cold card wallets after a software flaw made some generated seed phrases predictable. The ongoing attack has hit roughly 5,000 wallets and stolen about $110 million, shaking trust in devices marketed as crypto's safest storage. Pressure is mounting on FIFA President Gianni Infantino after plans to privatize the federation's commercial arm fell apart. UEFA, Europe's football governing body, says it has lost confidence in FIFA's leadership. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day and the week ahead. Plus, Mike Contopoulos of Janus Henderson on why inflation complacency is the biggest risk to markets.
From 08 period on, the Fed has been an open box. They've been completely transparent, and the market became addicted to knowing what the Fed was going to do. What Kevin is doing right now is he's trying to get the market off the addiction of me, the Fed chairman and the Fed board, having to tell you what we're going to do. This is a tough transition. People liked having the answers to the quiz before they took the test.
Gary Cohn was great a little bit earlier. Now IBM vice chair, a man who knows something about financial markets. I think a lot of people agree with him. In fact, I think for most people on Wall Street, I can find this many people who think that's exactly what the Federal Reserve should do. And then you start to talk about whether they're willing to pay the price, take the pain to do it. Then the group gets a little bit smaller and smaller and smaller.
I also think there's a question of method, how you get there. And ultimately, that's going to be what the Fed is deciding. Do you give some sort of indication of any kind of reaction function? Because you still don't have to hold the hands. There's not going to be the same kind of Fed put. Maybe moving to 6 meetings and then having 2 to discuss some sort of bigger concept wouldn't be the worst. Big themes, you know.
Big thinking stuff.
Let's talk about the Mets.
Debates we've never had before.
I mean, to me, it might not be a bad idea. All of these things are on the table. I look forward to Jackson Hole.
Huge economic issues at Jackson Hole once a year.
Inflation.
Right. Just inflation and the drivers of inflation. Things we've not thought much about.
I know. I haven't.
In the last
hasn't crossed my mind.
5 years. Equity futures right now in the S&P. Stop it. Positive by 0.6. On the Nasdaq, up by 0.2 as we count you down to the cash open. This is your week ahead. It looks like this. 9:45 Eastern Time. So PMI data. Get some ISMs through the week as well. Look out for that. On Tuesday, lots of Fed speak. Jobs data and results from SpaceX and AMD. On Wednesday, the labour market data continues. We'll get ADP data, plus more Fed speak from Cook and Daly. Thursday, the Fed's Musalem speaking, and another round of jobless claims before we get the July payrolls report. this coming Friday. In the meantime, stocks rising, oil falling, Treasury yields retreating from their highest levels in months going into the opening bell. Mike Contopoulos of Janus Henderson writing, the biggest risk to markets remains complacency about inflation and Fed action. Lower oil prices will help, but inflation is broadening and the Fed remains too easy. Mike joins us now for more. Mike, good morning.
Good morning.
Does the Fed see it the same way?
You know, it seems as though there are some concerns, certainly. I don't think we've heard, the Fed completely back away from the inflation risks out there. And I think that's actually been refreshing and something that, has certainly eased some concern from my perspective in terms of Chair Warsh coming to the Fed. So I do think they see it to some degree, but probably not to the same degree that maybe we see it at Janus Henderson.
Let's say you're right and they catch up and they understand they've got to catch up. What is there to like in financial markets right now?
I think, listen, the markets are not prepared for this. They're starting to get prepared for it. You've seen what's happened to some of the momentum trade and some of the longer duration assets out there, both in the equity and the fixed income side. Obviously we see what's going on the long end of the curve, but the 10-year is still 4.6, 4.65, and I think that could go quite a bit higher. And if it does, then the reverberations from that to broader financial markets should be could be pretty bad.
What are you seeing when you say that at Janus Henderson you truly are seeing broadening inflation pressures that people are not prepared for?
Yeah, I mean, you look at like import prices as a good example of this, right? We're importing inflation again. If you look at the trim mean, if you look at if you look at sticky inflation, notwithstanding the last month, those are starting to trend up. Core PCE bottomed in April of last year. The labor market remains really, really strong. I mean, you really haven't had jobless claims this low since the 1960s. There's not a lot to suggest that, you have a lot of disinflationary pressures. And I would argue that AI, at least so far, has been inflationary, not disinflationary.
So let's say this is the path of travel and the Fed remains on hold or hikes maybe once this year, isn't necessarily going to fight inflation with the front end of the yield curve. It will allow the long end of the yield curve to do the work. What does that do to the hundreds of billions of dollars of debt that have been issued by hyperscalers that have mostly had longer duration?
Yeah, listen, I think many of these companies, right, they still have pretty reasonably strong balance sheets. They still generate a ton of cash. So I'm not entirely sure that you're going to see, a Meta, Google, et cetera, go bust. We're not talking about bankruptcy risk here, but I do think it has knock-on effects to the equity. I think that you will see wider spreads, and we saw that last week, of course, with some of the deals not being nearly as oversubscribed as we've seen, prior to this month or last month. And that signaling from the debt market to the equity market, I think, could be pretty strong. You could see some pretty big revaluations on the equity side.
They can just cut spending. The government's going to have a much harder time of doing that, I would have thought.
Yeah.
So when I start thinking about the cost of capital going up, I'm wondering whether the sovereign is going to be more vulnerable to that than perhaps some of these companies that are doing all that spending. Meta can come out tomorrow and say, you know what, I'm not going to do this anymore.
That's true.
I'm not sure governments can do the same thing.
Governments can't do the same thing. We've kind of backed ourselves into a corner on that respect. And, you do wonder if you have a situation where the Fed doesn't get ahead of inflation, if you actually get sort of a Liz Truss moment in the U.S., and you get a big sell-off in treasuries as you get a buyer strike globally for U.S. debt. I'm not saying that's necessarily our base case, but we're much closer to that today than we've been maybe in quite some time.
Do you sense that the Treasury Secretary senses how much closer we are to that moment? Is that why he's a little bit more inclined to help the Japanese?
Yeah, I think there's some definitely a little bit, like I said, in the Fed as well. I think there's a little bit of sense that we are closer to that than in the past. I think the yen's an interesting one. I think you could see some asymmetry up to the upside there in the yen. And I think, with both governments sort of collaborating on this, I think that's a real possibility. And I do think part of that is because of fears around what could happen here.
If the long end of the yield curve keeps rising, what's more vulnerable, the bond market or the stock market?
Probably the stock market. I think, the stock market could get hit pretty bad. You've had so many years of excess, and I'm not entirely certain that you've got a huge credit issue. Earnings are still strong, but valuations in the equity side are so lofty in some areas of the market that I think you could get a pretty big revaluation, and equity investors are going to learn really, really quickly what a long duration equity is. So I think equity valuations could get crushed.
Do you think that's part of what we've seen over the past week, in addition to situational awareness, that this is a big leverage unwind that goes well beyond one particular fund?
It's going to be interesting to see if there's anything else out there for sure. It has a little bit, it rhymes a little bit with LTCM, and I'm sure, Bloomberg's written a lot about that over the last week or so. And then we'll see. We'll see what happens. You know, if you want to get very bearish, you could think of this as being sort of the bear hedge funds back, you know, in 07. I wouldn't go that far.
Glad to hear it.
But you know, it's got some similarities, right? Excess leverage in the system that we're not entirely sure where that hides out in, you know, obviously in the retail market in overseas. In Asia, but it could pop up in a lot of different places. And I think that's something, the longer this cycle goes and the easier monetary and fiscal policy is, the bigger of an issue it will ultimately be.
All these layers of vulnerabilities just stacking up one after the other over the last week.
And add to it a rapidly changing technology that is changing the economics underpinning a lot of the companies that are building out trillions of dollars of infrastructure. It just raises this issue. At what point will we figure out where the economics go, and will it leave a whole host of people behind?
Do you remember when summer was quiet? Do you remember those days? Seriously, when was the last quiet summer?
I know, this is ridiculous.
When was the last quiet
look,
summer?
That said, it's fascinating. And it's actually, it makes time go by very, very quickly.
Is it? Like, don't you just want that 1 month of just like nothing? That's what August is for.
Well, I want to take that time off. I don't want to have to talk about nothing, so that's fair.
Mike, it's good to see you. Thank you.
You too.
Mike Contopoulos there of Janus Henderson Investors from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. We'll see you tomorrow morning. This was Bloomberg Surveillance.